Please like, share, and subscribe. Wishing you happiness and good luck every day.
Today, we are going to get inside the minds of some of the most legendary investors who ever lived. Now, look, this is not financial advice, but what we are going to do is pull out the real wisdom from decades of their experience. We're talking about a mindset, a set of principles that they just work. And you can use them to make better decisions, not just in your portfolio, but pretty much anywhere in life. We're going to figure out what really separates the true masters from everyone else. You know, there's this one line that really just stops you in your tracks. Investing has changed more in the last 30 years than in the previous 300. Just think about that for a second. The speed of information, brand new technologies, whole new ways to invest that didn't even exist. It's a completely different planet from the old ticker tape days. And in a world that's changing this fast, this dizzyingly, the timeless wisdom from people who've seen it all, well, that becomes our most valuable compass. So that's the real question, isn't it? When the map is basically being redrawn in front of your eyes, how in the world do you find your true north? Well, the answer isn't some hot stock tip you see on TV. It's in the core principles that never, ever change. It's about the mental models that have guided the greatest financial minds through every single boom, every bust, and every revolution you can possibly imagine. So, here's our game plan. First, we're going to map out this new world of investing. Then, we'll dig into the investor's mindset. That's the real secret sauce. After that, we'll look at their actual strategies, go beyond the numbers to the human side of things, and even take a peek into the future. And then we'll wrap it all up with the one big takeaway you can actually use. Okay, so let's start with the lay of the land. You know, it wasn't that long ago that when you said the word investing, people thought of a very, very small menu of options. But as you're about to see, that menu has just completely exploded. This slide just lays it out perfectly. I mean, we started with the traditional stuff, things you could really wrap your head around, stocks, bonds, real estate. Then this alternative wave hit with more complex things like hedge funds and venture capital. But now we are deep in the cutting-edge era. We're talking crypto, SPACs, ESG. These aren't just weird niche ideas anymore. They're becoming huge asset classes. The playing field is bigger than ever, but that also means it's a heck of a lot more complicated to figure out. And all that complexity, it leads us to the single most important part of this whole thing. See, in a world that is just drowning in data, your real advantage isn't some faster computer, it's a better mindset. It's that intangible edge that a spreadsheet is never, ever going to be able to calculate. So you might think, okay, these guys must all be super geniuses, right? Well, not exactly. As the investor Stan Druckenmiller said, you probably need an IQ of about 120, but anything more than that is, and I quote, somewhat unnecessary. So if it isn't just raw brain power, what is it? Well, the real secrets are found in things like temperament, philosophy, and hard-won experience. And here's our first big clue from the legendary Sam Zell. He trusts his gut, but, and this is key, it's not just some random guess. He says intuition is the sum of your experiences. It's like this highly trained pattern recognition machine that you've built up over thousands and thousands of hours of wins and losses. It's what lets a master see the big picture that some fancy financial model with all its decimal points might miss entirely. And then you've got the other side of the coin, from the great value investor, Seth Klarman. You can have the best gut instinct on the planet, but it's totally useless if you don't have patience and discipline. The really great investors, they're not trading every 5 minutes. A lot of the time, they're just waiting. They have the strength to just sit on their hands, sometimes for years, until that perfect opportunity comes along. They're not chasing the market. They're letting the market come to them. This one from Ray Dalio is fantastic. This came after he made a huge, catastrophic bet that almost wiped him out completely. And what did he learn from it? Humility. The most dangerous thing for any investor is thinking you're certain about something. Dalia's great breakthrough was realizing that being aware of what you don't know is actually a superpower. It forces you to question your ideas, to look for people who disagree with you, and to build systems that can survive your own blind spots. So what all this really shows us is that there are these two big paths to success. You've got the artist, think Sam Zell, running on that finely tuned intuition. And then you've got the scientist, like Jim Simons, whose whole firm is built on pure data and algorithms. One trusts the gut, the other trusts the code. The true geniuses, though, the ones like Ray Dalio, they often figure out how to be both. Okay, so we've got the mindset down. Let's open up the toolkit. How do these great investors actually turn that philosophy into action? What are their core strategies? You know, at the heart of so many great fortunes is this one simple, incredibly powerful idea: value investing. It has nothing to do with timing the market or guessing what's going to be hot next week. It's about doing your homework, you do the hard work to figure out what something is really worth, and then you just wait, with that Seth Klarman kind of patience, until you can buy it at a massive discount. Buying a dollar for 50 cents. It sounds so simple, right? But actually doing it takes an incredible amount of discipline.
And this chart really shows you that not all investing is playing the same game. You've got venture capital on the left. That's like being a home run hitter in baseball. You are swinging for the fences, trying to get these massive returns, and you know you're going to strike out a lot. But that one home run can pay for all the misses. Then you have buyouts on the right. That's about hitting singles and doubles consistently. The returns are smaller, but your batting average is way, way higher. Knowing which game you're actually playing is absolutely crucial.
And this brings us to some fantastic advice from investor John Rogers for the rest of us. Don't try to be an expert on everything. You're not going to win by competing with Wall Street on their own turf. Your real advantage is your circle of competence, that one industry you already know inside and out. I mean, if you've worked in pharmaceuticals for 30 years, you have an edge there that no Wall Street analyst can ever match. That's where you should be looking.
All right, we've talked mindset, we've talked strategy, but there's this third pillar of success that a lot of people just completely miss. It has nothing to do with numbers or charts. It's all about people.
I mean, just let this one sink in. That's Larry Fink, the CEO of BlackRock, the biggest asset manager in the entire world, saying he spends almost a third of his time focused on culture. Why would he do that? Because he knows that a strong, resilient culture is one of the most powerful advantages a company can have. It's the glue that holds everything together when things get tough. And a lot of the time, the best investments are found inside companies with the best cultures.
And this focus on people, it extends everywhere. Investing is almost never a solo sport. It's about the quality of the people you partner with, the size of your network, and how prepared you are. But above all else, like investor Ron Barron says, it's about backing great leaders. Because at the end of the day, you're not just buying a stock. You're investing in the integrity, the vision, and the work ethic of the people who are actually running the show.
So now let's look forward. We've talked about these timeless principles, but how do they actually apply to all those new frontiers we saw at the very beginning of all this?
This slide really maps it out. Think about what these things really are. Crypto isn't just digital money. It's seen by many as a whole new way to build trust on the internet without needing a big bank in the middle. SPACs, they're just a different way for companies to go public, especially for ones that are selling a huge, bold vision of the future. Infrastructure is taking the smarts of private equity and applying it to the stuff our economy is built on: airports, data centers, you name it. And ESG is no longer just a feel-good checklist. It's becoming a serious way to spot long-term risks and opportunities that old-school analysis might totally miss. Wow, we've covered a ton of ground, haven't we? From the old-school principles of value investing all the way to the digital world of crypto. So let's boil it all down into a few core ideas for success. When you really put it all together, it comes down to these 4 things. First, and most importantly, master your own mind. Patience and discipline are your superpowers. Second, know what game you're playing and stay in your lane, your circle of competence. Third, remember that at the end of the day, it's always about people. Bet on great leaders and strong cultures. And finally, play the long game. As John Gray from Blackstone says, sometimes the real secret is just buying something great and having the guts to hold on to it through all the noise. So we're going to end not with a stock tip, but with this. It's a question that investor Ron Barron got from his rabbi. And it might just be the ultimate way to measure success in investing and in life. It changes the goal from just piling up money to building a life that has purpose and integrity. It's not just about the returns you make. It's about the person you become while you're making them. Thanks for joining us.
You hear his name all the time, Larry Fink. Some call him the king of Wall Street, the man at the absolute center of the global financial system. But his story, it isn't what you think. It's not some straight line of success. It's actually a story about a massive, catastrophic failure, a complete loss of confidence, and how that one moment led to the creation of the most powerful investment firm on the planet, BlackRock.
Okay, just to get a sense of the scale we're talking about here, look at this number, $9.6 trillion. To put that into perspective for you, that is more than the entire annual economic output of every single country on Earth except for the US and China. So the real question we're going to dig into isn't just what this number is, but how in the world one firm, led by one guy, came to control so much of the world's money. And you know the answer? The core idea that has driven every single decision they've ever made. It's right here in Larry Fink's own words. It sounds so simple, right? Almost too obvious. But you have to remember, in the cutthroat world of 1980s Wall Street, a world that was all about the quick trade and the big bonus, this idea of relentlessly focusing on the client, that was actually a pretty radical concept.
So here's our game plan for this explainer. First, we're going to really wrap our heads around the true scale of BlackRock's influence. Then we'll hit rewind and go back to the story of this Wall Street wondercan who lost it all, and see how that failure became the spark for everything that came next. We'll uncover BlackRock's secret weapons, see how they built an empire, dig into the philosophy that guides it all, and we'll finish up with what Fink thinks is coming next for all of our financial futures.
All right, let's dive into our first section, the $9.6 trillion man. Look, that number is just staggering. But BlackRock's real power isn't just its size. It's about how deeply it's woven into the very fabric of global finance. It's almost like it's the operating system for the world's money.
I mean, just look at how far their reach extends. Yeah, they're the biggest asset manager, but they are literally everywhere. Stocks, real estate, the ETFs that are probably sitting in your retirement account right now. And that 1.9% of global capital markets, that might not sound like a lot, but believe me, it's a colossal footprint. But the influence, it goes way beyond the numbers. Fink himself has become this essential informal advisor. When central bankers and presidents need to know where the money is really moving, they don't just look at spreadsheets. They get Larry Fink on the phone.
So how did this whole thing even start? Well, to really get what BlackRock is today, you absolutely have to understand the fire that forged its founder. It's a classic Wall Street story, really. A rise so fast it's dizzying, a fall that's absolutely spectacular, and then a rebirth from the ashes.
So picture this. Fink gets his MBA, lands at a firm called First Boston, and he's not just good, he's a game changer. He helps create the whole market for mortgage-backed securities. Bundling up thousands of home loans and selling them as an investment. It was a move that totally changed housing finance. He was a superstar. By the time he's 31, he's on the management committee, the youngest guy ever. And then, bam, 1986. It all comes crashing down. His department, once the star of the firm, completely misjudged interest rates and lost $100 million in just one quarter.
And this wasn't just some bad quarter on a spreadsheet. This was a deeply personal failure. He went from being the golden boy of the firm to basically being a pariah overnight. Fink says that in that moment, the whole idea of partnership at the firm just vanished. When things went wrong, he was completely on his own. It absolutely shattered him.
But, out of that total disaster, he basically forged his new commandments. He learned 3 incredibly hard lessons that would define everything he did next. Number 1, you absolutely have to have a deep technological understanding of risk. Number 2, the word partnership on Wall Street is pretty much meaningless if there's no real loyalty. And number 3, the only way to build a firm that lasts is to put trust and the client's needs at the very center of everything you do.
So 2 years later, in 1988, he and 7 partners decided to build the thing they couldn't find anywhere else. They got together with Blackstone's Stephen Schwarzman and Pete Peterson, and they secured a $5 million line of credit to get started. Fink wasn't just starting another company. He was trying to build the true partnership he felt he lost, a firm that was designed from day one to never, ever repeat the mistakes of his past. Okay, so that brings us to the really interesting part. BlackRock's secret sauce. What made this new firm so different? Well, it wasn't just one thing. It was 2 incredibly powerful, connected forces that Fink built from the absolute ground up. A revolutionary piece of technology and a culture you just couldn't shake.
This is it. Meet Aladdin. This is the technological answer to that $100 million loss. It started as a risk management system, his personal vow to never again get blindsided by a risk he couldn't see. But it grew into so much more. Fink calls it the heart of the firm, a single technology platform that connects every single part of their global operation.
Think about what this really means in practice. Every single employee, no matter where they are in the world, is looking at the same data, speaking the same language. It gives them incredible risk analysis, for sure, but it also creates insane efficiency and reinforces that unified culture. It's their central nervous system. I mean, when the pandemic hit, BlackRock switched to remote work almost overnight because their entire operation already lived on Aladdin.
Now, having amazing tech and a great culture is a powerful engine, but that alone doesn't get you to $9.6 trillion. BlackRock's insane growth was supercharged by a series of really smart and, frankly, pretty unconventional acquisitions.
And this is where you see a huge difference in philosophy. Most mergers on Wall Street are about cutting. You buy a competitor, you fire a bunch of people, and you slash costs to make the numbers work. Fink's approach was the total opposite. He saw acquisitions as a way to add things, add new skills, add new talent, and ultimately offer clients more. A year after their biggest deals, they often had more employees, not fewer. It was always about growth, not just consolidation.
And here are the 3 big moves that really built the empire. The State Street deal in 2005, that was the test run. It proved they could plug another firm into their Aladdin system and make it work. A year later, buying Merrill Lynch's asset management business gave them a global footprint in stocks, which was huge. They were no longer just a bond shop, but the real masterstroke, that came in 2009, right in the middle of the financial crisis, when they bought Barclays Global Investors.
That BGI deal, it came with something called iShares. Back then, ETFs, exchange-traded funds, were still kind of a niche product. But Fink saw the future, and wow, did that pay off. The growth has been nothing short of astronomical, from less than $500 billion in 2009 to over $3 trillion today. This one single, incredibly bold acquisition, made when everyone else was running scared, put BlackRock at the dead center of the biggest investing revolution of the last 20 years.
All right, so we've seen how they built it, but what's the philosophy that actually powers this whole thing? What are the core beliefs that drive Larry Fink's leadership? Well, it really all boils down to a few powerful guiding ideas.
First off, there's long-termism. That's a direct rejection of that short-term thinking that burned him so badly at First Boston. Second, that client focus is the real deal. He is constantly reminding his team that 2/3 of the money they manage is for retirement. The mission isn't just to make a number go up, it's to help people retire with dignity. And finally, lifelong learning. The moment you think you've got it all figured out, he says, is the moment you're about to make your own $100 million mistake.
And this brings us to a really hot topic, ESG, environmental, social, and governance investing. Fink gets hit from both the left and the right for his focus on this stuff. But if you listen to him, his framing is just pure pragmatism. For him, it's not about politics, it's about risk. He believes understanding climate risk is no different than understanding interest rate risk. It's just another crucial piece of data you have to measure if you want to protect your client's money for the long haul.
Okay, so with all that power, all that influence, where does a guy like Larry Fink see the world heading? For our last section, let's look at the huge shifts he believes are going to define the next era of investing, not just for him, but for all of us.
And this right here, this is probably his most serious warning. He is convinced that the fundamental economic reality that has shaped the markets for the last 30 years, an era of globalization, cheap labor, and falling prices, is over. Done. That massive tailwind that we all got used to is gone. And any investor who thinks the old rules still apply is, in his opinion, making a huge mistake.
And what makes that new, more volatile economic reality even scarier is what he calls the biggest silent crisis in the world: retirement. Think about it. In an age of higher inflation and probably lower investment returns, the challenge of saving enough money for a life that's getting longer and longer, it becomes exponentially harder. This is the one problem that seems to keep him up at night. How do we make sure people can actually afford to live with dignity after they stop working?
So this leaves us with a final and pretty critical question. If that 30-year economic party is really over, and this silent retirement crisis is getting worse, does everything we thought we knew about saving and investing need to be completely thrown out? According to the man who built a $9.6 trillion empire by obsessing over risk, the answer to that is a resounding yes.
The investment world today, it's pretty much dominated by computers, right? Index funds, passive strategies, algorithms making all the decisions. But what if I told you there's one guy who for 40 years has proven that old-school, active stock picking isn't just alive, it can absolutely crush the market? Today we're going to dive into the playbook of a living legend, Ron Barron, a man who built a multi-billion-dollar firm by doing one thing: ignoring the crowd and playing the long game.
So, just how good is he? Well, let's start with this number: 500. What does that mean? It means 500 basis points, or a full 5%. See, since 1982, Ron Barron's funds have, on average, beaten their market indexes by 5% annually. Now, in the world of investing, where most of the pros fail to beat the market at all, that kind of number isn't just impressive, it is almost unbelievable.
And this quote, this gets right to the heart of how he does it.
For Ron Barron, investing isn't some game. It's not about chasing hot stocks or trying to time the market. It's a serious, long-term responsibility. It's about building and protecting wealth for your family for generations. And that single idea, that philosophy, completely separates him from all the noise you hear on Wall Street every day. All right, so here's what we're going to cover. First, we'll break down exactly how he beats the market in an age that's obsessed with passive investing. Then we'll dig into his core invest forever philosophy. We're going to see it in action with his legendary bets on some true visionaries, uncover his really surprising origin story, and then wrap it all up with his personal blueprint for you, for all of us investors. Okay, first up, beating the market. To really get a grip on what Barron has accomplished, you first have to understand the world he's operating in. I mean, over the last couple of decades, there's been this massive tidal wave of money just flooding into passive index funds and ETFs. The whole idea is based on this belief that it's just about impossible to beat the market averages over time. So here's the fundamental difference, right? Over on the right, you've got passive investing. It's simple, it's super cheap, and all it tries to do is match whatever the market does. But on the left, that's what Barron does, active investing. That's using your brain, your judgment, doing deep research to find specific companies that you believe are going to outperform everybody else. Most people these days think the passive way is safer, smarter. Well, Ron Barron has spent his entire life proving them wrong.
And the proof, as they say, is in the pudding, or in this case, the numbers. $55.3 billion. That's the value of assets under management at his firm, Barron Capital. Think about that. That's how much trust investors, we're talking everyone from huge institutions to regular families saving for college, have put into his active, human-led approach. Now, here's what's so interesting. Ron Barron himself is the very first person to tell you just how hard this is. He says most active managers fail because they get caught up thinking they know better. They think they can predict the economy or what interest rates are going to do, and they trade based on that. But they don't really have an edge. So, if that's true, what in the world is Ron Barron's secret? And that question brings us right to section 2, the invest forever philosophy. This, right here, is the absolute core of how he pulls it off. It's got nothing to do with predicting the market. It's all about identifying and then owning pieces of exceptional businesses for a very, very long time. His criteria for picking an investment look pretty simple on the surface, but they're incredibly powerful. First, he invests in great people. We're talking visionary leaders with integrity that he can actually trust. Second, the business has to have a serious competitive advantage, what some people call a moat, that protects it from rivals. Third, it's got to be plugged into a massive long-term growth opportunity. And finally, and this is the key to the whole thing, the plan is to own it forever. You're not just renting a stock, you're buying a piece of a business. So why is holding forever the secret sauce? Well, for one, it's a huge tax advantage. Every time you sell a winning stock, Uncle Sam comes calling for his cut. It also saves you from getting blood dry by trading fees. But the real magic, the big idea, is this. Barron knows that trying to predict the market's ups and downs is a fool's errand. The only way to capture the truly explosive power of a great business is to give it the one thing it needs most, time. Time to let that magic of compounding really do its work. But that leads to a really important question, doesn't it? I mean, it's easy to say, I'll hold forever when a stock is shooting for the moon. But what about when it goes nowhere? For 6 straight years. What kind of conviction, what kind of stomach does that take? Well, let's look at a very famous real-world example. And this brings us to probably his most famous investments. These are the ultimate case studies for his entire philosophy, his huge, massive bets on Elon Musk's companies, Tesla and SpaceX. So let's break down this Tesla bet. Step 1, the leader. This wasn't a bet on a car company. It was a direct bet on Elon Musk's vision and his unbelievable ability to execute. Step 2, the investment. He put in $380 million between 2014 and 2016. Now, step 3, the wait. And this is where almost every other investor on the planet would have sold. For about 6 years, the investment did basically nothing. But Barron held on. And the result? The payoff. A staggering $6 billion in profit. And this quote just brilliantly shows you his mindset. Even after making something like 20 times his money, he's not cashing out. He believes the real long-term growth story is just getting started, and that the company could triple or even quadruple from here. Now that is the definition of long-term conviction. You know, his investment in SpaceX follows the exact same playbook. He saw a visionary leader in Musk who was disrupting this old, stagnant industry with a game-changing competitive advantage, reusable rockets. And he saw that this one innovation could unlock a potential trillion-dollar market in global satellite internet.
See the pattern? It's always about the person, the competitive advantage, and that enormous long-term opportunity.
So you have to wonder, where does this incredible patience, this unbelievable conviction, come from? Well, that takes us to his origin story. And let me tell you, it is not your typical Wall Street fairy tale. This is the making of a true maverick. When you look at this timeline, you see a path that was defined by grit, not by privilege. His parents really wanted him to be a doctor, but a summer job cleaning bedpans in an ER pretty quickly ended that dream. To avoid the draft, he became a patent examiner and started going to law school at night. He finally broke into Wall Street as an analyst in 1970, only to get fired after his very first year for making a call that was too controversial. It wasn't until 1982, after years of just grinding it out, that he finally started his own firm. And this quote, this is really the emotional core of his entire story. After getting fired and not being able to find work, he was ready to give up. He was actually thinking about opening a bicycle shop. But his father gave him this advice, a simple but incredibly powerful push to just keep going. That perseverance, which was forged through years of struggle, that's the foundation of an investment philosophy that requires just incredible, almost inhuman patience. All right, let's wrap this up by distilling everything down into an actionable blueprint. What can we all learn from Ron Barron's incredible career? What can we apply to our own financial lives? First things first, forget the spreadsheets and the balance sheets for just a second. For Ron Barron, it all starts with the person in the corner office. He's looking for this rare combination of genius-level smarts and a blue-collar work ethic, all mixed together with unshakable integrity. He knows that when you invest in a company, you're not just buying a stock ticker, you're becoming a business partner with the CEO. So what does he think is the biggest mistake that average investors make? It's this, right here. People confuse how easy it is to trade with the actual skill of investing. He says just because technology lets you buy and sell stocks in a split second from your phone doesn't mean you can actually do it successfully. It's a profession, like being a dentist or a pilot, and just dabbling in it often ends in disaster. And this brings us to his fundamental definition of the word investing itself. It is not trading. It is not speculating. It is not about what a stock will do next week or even next quarter. The whole point, the crucial idea, is that investing is the act of becoming a part owner in a great, growing business with the single goal of securing your family's future over decades. So his final advice is really clear and it's powerful. First, do the work. Really study the businesses you plan to own. Second, think big. Understand the massive technological and demographic shifts that are shaping our future. Third, raise the stakes. Make every single investment decision as if your family's entire future depends on it. And finally, just be consistent. Invest a set amount year in and year out for the long, long term. And that leaves us with one final, and I think pretty provocative thought. Our phones, the apps on them, the financial news, everything is designed to make us trade, to react, to be short-term. The entire system is built for traders. The question Ron Barron's career forces every one of us to ask ourselves is this: in that world, do you have the mindset, the patience, and the discipline to be a true investor? All right, picture this. The stock market is in a total freefall. Everyone's panicking, selling everything they own. It's absolute chaos. But then you see one person, just one, calmly walking against the crowd, buying things up. Who is that person? Well, today we're diving into the mind of a true investing legend, John W. Rogers Jr., to understand the philosophy that made him do just that. We're talking about contrarian courage. And boom, right there. That's it. That's the whole philosophy in one sentence. It's the foundation of everything he's ever built. When most people see a 5-alarm fire in the market and run for the hills, Rogers sees a fire sale. He's looking for those bargains that nobody else has the guts to pick up. That's the mindset we're going to get into today. So where does this all begin? Let's rewind the clock. The year is 1983. The market's kind of shaky, just getting its feet back under it after a tough stretch. And in Chicago, a young guy has this incredibly bold idea.
And get this, he was only 24. 24! I mean, think about what you were doing at 24. Most of us are just trying to figure out our careers. This guy, John Rogers, he was about to go out and change the game completely.
So we're talking about a pioneer's audacious idea. What exactly was it? Well, this wasn't just about hanging a shingle and starting another investment firm. No, this was about doing something that had never been done before. He founded what became the very first African-American-owned mutual fund company in the entire United States. Think about that for a second. This wasn't just a business move. It was a historic moment, a total game changer.
So
How does a 24-year-old get to that point? Well, the seeds were planted early. At just 12 years old, his dad starts giving him stocks for birthdays and Christmas instead of, toys. That sparks something. Then he goes to Princeton, where he's not just studying economics, he's also captain of the basketball team. After college, he gets a job at William Blair & Co., where he breaks a barrier, becoming their first African-American professional. But he wasn't there long. At 24, he decides to go for it. He leaves his job and starts aerial investments with seed money from family, from friends. His own mother gave him every last bit of cash she had. Talk about a leap of faith.
Okay, so you have this trailblazing company, but what's the engine behind it? What's the actual philosophy? Let's get into how he forged this contrarian mindset. Because it didn't just appear out of thin air, right? He was really standing on the shoulders of giants. The whole thing is built on this one core idea, value investing. Now, what does that actually mean? It's pretty simple, really. It's not about chasing the latest hot tech stock or whatever's trending. It's about being a bargain hunter. Think of it like this. You're looking for a designer coat at a thrift store price. You do your homework, you figure out what something is really worth, and then you just wait patiently for the market to mess up and give it to you on sale. And he learned this from some of the best. His professor at Princeton, Burton Malkiel, taught him all about the madness of crowds, how people just follow each other, often right off a cliff. Then you've got the legends, right? John Templeton, who modeled this idea of buying at the point of maximum pessimism. And of course, Warren Buffett with his famous line about being greedy when others are fearful. But it wasn't just Wall Street titans. He was also deeply inspired by local Chicago entrepreneurs, guys like John H. Johnson, who built massive businesses and showed him it was possible. Let's just pause on this one from Sir John Templeton for a sec. Buy when there's maximum pessimism. That is just so counterintuitive, isn't it? Your gut, every fiber of your being is screaming sell when things look terrible. But Templeton's point, and Rogers' philosophy, is that's precisely the moment the biggest opportunities are born.
And you see the exact same idea coming from Warren Buffett, just in his own words. Be greedy when others are fearful. It's the same principle. These guys are basically saying that fear is your best friend as an investor. It's the thing that creates the sales rock. It's what lets you buy $1 for 50 cents.
Okay, look, it's one thing to have these nice quotes and a solid philosophy on paper. But what happens when a real storm hits? When the sky is actually falling? That's the real test of your conviction. And John Rogers has been through some serious financial storms.
So yeah, what do you do when that maximum pessimism isn't just a theory, but it's your reality? When it feels like there's no bottom, and every single person on TV is telling you to get out of the market right now.
Well, for John Rogers, you look at these moments, Black Monday 1987, the massive financial crisis in 08 and 09, the COVID panic in 2020, for him, these weren't disasters. He literally calls them chances of a lifetime. While everyone else was liquidating, he was on the phone telling his clients, this is it. This is our chance. Send us more money.
But man, let's not pretend this was easy. It was brutal. During the 2008 crisis, Ariel's assets, their entire pool of money under management, dropped by 50%. Half. Just gone. Imagine watching your life's work get cut in half. They had to lay people off for the first time ever. Even long-term clients were pulling their money out. The pressure must have been absolutely immense.
And yet, in the middle of all that pain and pressure, this was his mindset. He said it was like being a kid in a candy store. How is that possible? Because while the business side was hurting, the investor in him was ecstatic. He was seeing fantastic, solid, boring companies, the kind of businesses that just make money year after year, being sold at 70, 80% off. His belief in his strategy was just stronger than his fear of the moment. That right there is the definition of contrarian courage.
So, the big question is, did it work? All that stress, all that going against the grain, did this long road to success actually lead anywhere? Let's take a look at the scoreboard. Well, the numbers really do tell the story. If you look at their main fund, the Ariel Fund, since way back in 1986, it's averaged an annual return of almost 12%. And that's after you take out the fees. More importantly, that performance has consistently beaten the big benchmarks, like the S&P 500. That's what you get for sticking to your guns for decades. And the firm itself, the growth is just staggering. Look at this. They started in 1983 with 3 people in one office in Chicago. And that initial capital, just a couple $100,000 scraped together from family and friends. Fast forward to today, you're talking over 110 people, 4 offices around the world, and more than $17 billion under management. That's not just growth, that's an empire built on a philosophy. So this is all great, but what are the actual lessons we can pull from this? What can you and I learn from a lifetime of being a patient, contrarian investor? Well, Rogers has broken it down into a few core principles that are surprisingly simple.
All right, here they are. Number 1, fight confirmation bias. Basically, don't just look for information that confirms what you already believe. Go out of your way to find people who disagree with you. Actively challenge your own ideas. Number 2 is great. Embrace your quirkiness. Roger says that his ability to just be different, to stand alone and not care what the crowd thinks, that's his superpower. And finally, number 3, look over the horizon. Stop getting bogged down in today's drama and today's headlines. Think 3, 5, even 10 years out. Play the long game.
Now, to help him do that, to help him maintain that long-term focus, he has this, well, the secret weapon for productivity. And I gotta tell you, in our hyper-connected world, it's pretty shocking. The man does not use email. Seriously, no email. He thinks it's a massive time suck that just pulls you into the day-to-day noise and distraction. By cutting it out completely, he carves out the time he needs to do the deep thinking, the deep reading that his job requires. It's a powerful lesson in just how important it is to control your own time and your own focus. And really, that brings us to the final thought here. We live in a world of just constant noise, right? Notifications, alerts, breaking news. It's designed to keep us focused on the next 5 minutes. The lesson from John W. Rogers Jr. isn't really just about investing in stocks. It's about investing, period. It's about patience, it's about conviction, and it's about having a long-term vision. So it kind of leaves you with a question to think about. In this world of noise, what are you patiently investing in?
So what's the real difference between a good investment and a truly legendary one? It's not just about the spreadsheets, it's about conviction. Today, we're going to crack open the playbook of John Gray, the guy who is basically the architect behind Blackstone's massive real estate empire. We're going to look at the strategies, the deals that almost blew up, and the ones that made billions and really defined a whole generation of investing.
And really, this is it. This is a whole philosophy in a nutshell. This isn't just some nice quote he throws around. It is the bedrock for every single decision we're about to get into. It's the difference between just kind of dabbling in something and absolutely dominating it. It's having the guts, which comes from truly understanding something, to run into the fire when everybody else is sprinting for the exits. And that's the big question, right? How does a pretty simple idea turn into a staggering $14 billion profit on a single deal that was on the verge of total collapse? I mean, the story is just a masterclass in strategy, perfect timing, and pure nerve. So to understand how they got there, we have to go all the way back to the beginning.
Now, our story starts in a place you would probably never guess. See, John Gray wasn't some prodigy groomed for real estate royalty. In fact, his journey to becoming this titan of the industry, it kind of started by accident. Can you believe it? Before he was moving billions of dollars around, he was an English major. His dream was to be a journalist. When he first walked in the door at Blackstone way back in '92, he wasn't structuring these huge, complex deals. His job? Running numbers, making pitch books, and, as he puts it, making sure the senior guys got their dinner on time. A pretty humble start.
And then chaos hit the market, and that chaos created an incredible opportunity. The savings and loan crisis had absolutely decimated real estate. There was wreckage everywhere. But while most people saw ruin, the founders of Blackstone, they saw a once-in-a-generation buying opportunity. So they decided to start a real estate group, and they basically just needed people. Gray had helped out on a memo for their first fund, so they tapped him. As he says himself, luck is a core competency, and boy was this his moment.
His very first deal wasn't some huge skyscraper in Manhattan. Nope. It was a $6 million shopping center down in Chesapeake, Virginia. Blackstone put up $2 million in cash, and Gray says the way he obsessed over it, you would have thought he was buying the entire city of New York. He spent 3 solid weeks on the ground, just determined to learn the business from the absolute ground up.
Forget Harvard Business School. This was his real MBA. He wasn't just some analyst crunching numbers from an office. He was, the chief, cook, and bottle washer. He personally met with every single tenant in that shopping center. He'd spend his days literally counting the cars in the parking lot just to understand how healthy the business was. And this incredible education in the gritty details, that's what built the foundation for everything that came next as the deals went from millions to billions.
All right, so this is where the scale just shifts dramatically. Let's fast forward to 2007. The market is absolutely red hot.
And Blackstone is about to make a move that will literally go down in history, the single largest real estate deal ever done. A huge gamble right at the very peak of the cycle.
Just look at that number, $39 billion. That was the price tag to buy equity office properties. This was the largest portfolio of office buildings in the entire US, and it was put together by the legendary Sam Zell. This was a true bet the farm kind of deal, the kind that would cement Blackstone's and John Gray's reputation forever.
So how in the world did they pull this off without blowing up the entire firm? Well, they had this brilliant strategy that Gray calls wholesale to retail arbitrage. The best way to think about it is like this. Imagine you go out and buy a giant fruit basket. You've bought the whole thing, right? But before you even pay for it, you've already lined up buyers for the grapes and the bananas, the pieces you don't really want. You take their cash and immediately use it to pay for the whole basket. What are you left with? You own the best stuff, the apples and oranges, at a fantastic price. And that's exactly what they did, keeping all the crown jewel properties in the best cities.
But here's the absolute genius move that made the whole thing work. A competitor started driving the price up in a bidding war, and Gray knew he had to lower his risk. So, he goes directly to Sam Zell with this critical request. He says, listen, if you want me to keep bidding, you have to let me talk to other buyers right now. And Zell agreed. This one move, this masterstroke, allowed Blackstone to pre-sell almost 2/3 of the portfolio before they even officially owned it. It totally de-risked the deal and gave them the firepower they needed to win the whole thing.
Okay, so if the EOP deal was a masterclass in brilliant strategy, this next one, this was a gut-wrenching lesson in pure, unshakable conviction. This is the story of the deal that almost broke them, but in the end, became the single most profitable private equity deal in history.
The company was Hilton Hotels. And you have to understand, this wasn't just about buying up buildings. It was kind of a two-for-one play. On the one hand, yes, Hilton owned these iconic, irreplaceable properties like the Waldorf Astoria. But on the other hand, it also had this incredibly powerful corporate engine, a massive global business that managed and franchised its brands. It was a phenomenal business at what looked like a pretty reasonable price. The only problem? Their timing.
Their timing couldn't have been worse. I mean, it was catastrophic. Less than a year after they closed the deal, the 2008 global financial crisis hits, the world just stops. Travel grinds to a halt, Hilton's revenues just fall off a cliff down 20%, and its cash flow, the absolute lifeblood of any business, plunged by a staggering 40%.
Internally, things were so bad that Blackstone had to write down the value of their investment by a crushing 71%. Just try to imagine that. Your biggest deal ever is now, on paper, worth less than 30 cents on the dollar. This was that moment of maximum pain, where every single instinct you have is screaming to just cut your losses and run away.
So why didn't they sell? Well, this right here is where that idea of conviction really gets tested. Gray believed they hadn't just bought a chain of hotels, they'd invested in a great neighborhood. They understood that the crisis was a temporary storm, but that the long-term tailwind of global travel, that was like an unstoppable force of nature. The brands were iconic, the business itself was fundamentally solid, they just had to survive the storm.
And this is the most crucial part of the story. They didn't just hold on, they actually doubled down. Right at the absolute bottom of the market, they pumped another $800 million into the business. And sure enough, as the world recovered, Hilton just roared back to life. They eventually took it public, and when all the dust settled, that 71% paper loss had transformed into a $14 billion profit. It was a painful, searing, but ultimately legendary validation of their entire philosophy. So these two incredible stories really show you the high-stakes world of opportunistic investing. But, it's not just about luck and having guts. It's all based on a pretty clear framework. So let's actually break down the basic playbook that investors like Gray use to think about the whole field.
Probably the easiest way to think about this is to compare it to the bond market. So on one end of the spectrum, you've got core real estate. This is like your super safe AAA-rated bond, a beautiful, fully leased building with a rock-solid tenant. Very low risk, but also low return. Then on the complete opposite end, you have opportunistic. This is your high-yield junk bond. It's much riskier. Maybe it's an empty building or a big development project, but it offers the potential for much, much higher returns. And core plus and value add are just the categories in between.
And this opportunistic bucket, this is the sandbox where Gray and Blackstone basically became legends. It's the classic buy it, fix it, sell it strategy. The idea is you find a broken asset, an underperforming, rundown, or maybe empty property, you inject a bunch of capital and operational know-how to fix all its problems, and then you sell the now stabilized asset. The goal here is to get private equity-level returns, usually targeting something over 15% for your investors.
Okay, so we've looked at the billion-dollar deals. We've defined the playbook. But what does any of this mean for you? How can these lessons from the very top of the investment world actually apply to us?
Well, first, it's so important to remember that even the masters get it wrong. Gray is really open about his worst deal ever, an office building he bought during the dot-com bubble. The main tenant was a company called GoBosh.com, and Gray jokes, "I should have stayed home." The tenant went completely bankrupt just 3 months after they closed the deal. It's a painful but really powerful reminder that a huge part of being a great investor is learning from your mistakes.
And that brings us to the core principles we can all actually use. First, be a high-conviction investor. Do your homework so you can act with real confidence and don't just dabble. Second, focus on the long term. You've got to tune out the daily noise of meme stocks and what he calls the Insta world. Third, find those great neighborhoods. Look for sectors with powerful long-term tailwinds where demand is growing and supply is tight. And finally, maybe the simplest advice of all. When you own something truly good, just have the patience to hold on to it.
Which really leaves us with one final big question. If you take John Gray's framework, this whole idea of finding great neighborhoods with these unstoppable tailwinds, where would you look to invest today? What are the big fundamental trends that are going to shape the next decade? Because really, answering that question for yourself, that's the first step in making any great investment.
In the world of investing, you've got your button-down analysts who live and die by their spreadsheets. And then you've got the originals, the larger-than-life figures who operate on gut instinct, who absolutely thrive on impossible challenges, and who are never, ever afraid to speak their minds. Today we're diving deep into the playbook of one of the last true originals, Sam Zell. Okay, let's just start with the single most important idea in Sam Zell's entire universe. This quote, "This isn't just some clever little saying for a book. This is the bedrock principle that guided a multi-billion-dollar empire." See, for him, it wasn't about chasing the upside. It was about obsessively, relentlessly understanding and controlling the downside. And that right there is the key that unlocks absolutely everything else about him. We're going to see this exact principle play out over and over again. So Zell famously gave himself this nickname, and it is just perfect, isn't it? The image it brings to mind, dancing on the graves of failed deals, it really says it all. But he wasn't some vulture just picking at a carcass. No, that's not it at all. He was more like a financial resurrector. He could see a heartbeat and a massive opportunity where everybody else, and I mean everybody else, just saw a tombstone. All right, so here's our roadmap for today. We're going to start with who Sam Zell really was, trace his kind of surprising path into real estate, and then see how he completely mastered that game. From there, we'll check out his move into all sorts of other industries, we'll distill his core principles, his playbook, and we'll finish up with the personal philosophy that really fueled his entire life.
So, before we can even begin to jump into the billion-dollar deals and the massive companies, we really have to understand the man behind them. I mean, what made Sam Zell the original grave dancer?
Well, Zell was a total throwback. In an age of endless data and analytics, he was deeply suspicious of anyone who could write a 100-page memo. He used to joke about whether he could even read one without falling asleep. And he was famous for his blunt, often colorful language. I mean, get this. His autobiography is literally titled, "Am I Being Too Subtle?" But that bluntness, that intense focus on what was real, that was his superpower. It let him just cut through all the noise and see the true value, or the lack of it, in any deal. Now, you might think a guy like this, had some brand plan from day one. But the truth is, his journey to becoming a real estate titan was almost an accident. It was born out of a desire to avoid a career he found, well, excruciatingly dull. So Zell's parents were Polish immigrants who had narrowly escaped the Holocaust. And their advice to him was simple and, born from that terrifying experience. Get a profession, something you can always use to make a living. So what does he do? He goes to law school. The only problem, he found it, and this is his own words, horrendously boring. So while all his classmates were buried in case law, Zell was out making deals. He actually convinced a local landlord to let him manage a 15-unit apartment building just in exchange for a free place to live. That one side hustle, it quickly turned into managing multiple properties. He was still in law school, but he was already running a real business. Let's just say the legal textbooks never stood a chance.
Just think about that for a second. 4 days. He did everything his parents wanted. He graduated, passed the bar, got the respectable job, and he lasted just 4 days. That was all it took for him to know his future was not in a courtroom. It was out there in the world of assets and leverage and deals. He quit, and he never, ever looked back.
Okay, so he leaves law in the dust and goes all in on real estate. But what was it about this specific world that was so appealing to him? Well, it really came down to 2 incredibly powerful financial concepts. And this right here is where you start to see Zell's true genius. See, he wasn't just trying to earn an income. He was laser-focused on building net worth. And real estate gave him 2 incredible tools to do it. First, leverage. You can borrow a huge percentage of a property's value, way more than in almost any other industry. But second, and this is so critical, that debt was often non-recourse. What that means is, if a deal went sideways, the bank could take the building, sure, but they couldn't come after his other assets. It was a built-in risk containment strategy that let him take these massive swings, but with a safety net.
So using these tools, he builds an absolute empire. And the crown jewel of that empire was a company called Equity Office Properties, or EOP. It was the largest collection of office buildings in the entire United States. He and his team built it to be so massive, they actually thought it was literally too big to be bought. And then the phone rang.
This was his legendary response to a broker who called asking what it would take to sell EOP. It's pure Zell, it's blunt, it's a little bit arrogant, and it set an impossibly high bar. He wasn't just saying it's not for sale. He was daring them to make him an offer he couldn't refuse. And that one line, that one quote, kicked off one of the biggest real estate bidding wars in history. And here's where the masterclass really begins. So Blackstone comes to the table with a huge $36 billion offer. Now, most people would have taken that money and sprinted to the bank. Not Zell. He ran a masterful auction. He brought in a rival bidder, got them competing, and drove the price up. And the result? Blackstone was forced to raise its own bid to a staggering $39 billion. He squeezed an extra $3 billion out of the deal just by creating competition. And then, in a move of what he later called accidental genius, he sold the entire thing at the absolute peak of the market in 2007, just months before the entire financial world came crashing down. Incredible. So after basically conquering the real estate world, you might think he'd just stick to what he knew. But Zell and his partner realized that the principles they'd mastered, supply, demand, market logic, well, they could be applied pretty much anywhere.
This was a massive turning point. Back in the early 80s, he and his longtime partner Bob Lurie took a hard look at the real estate market. And frankly, they didn't like what they saw. It felt overheated. So they made a bold pact right then and there. Within a decade, they would diversify until half of their investments were completely outside of real estate. They believed their skills were transferable, and they were about to prove it. And would you look at the result? They didn't just meet their goal, they blew right past it. The portfolio eventually became heavily weighted towards non-real estate assets across a huge range of industries. We're talking manufacturing, logistics, healthcare, energy, even agribusiness. This is all the proof you need that their strategy wasn't just about buildings. It was a universal playbook for finding value anywhere and everywhere. So what was the secret? I mean, how did he grave dance with corporations instead of skyscrapers? It all boiled down to this one simple but incredibly powerful thesis. He looked for fundamentally good businesses, companies that made a great product or provided a crucial service, that were in trouble not because of their operations but because they had taken on way, way too much debt. He knew how to fix a balance sheet, and that meant he could buy up these great companies for pennies on the dollar. Okay, so we've seen the stories, we've seen the deals. Now let's try to distill all of that experience into a concrete set of rules, the official iconoclast playbook for investing, for hiring, and, just as important, for knowing when to walk away. First up, people. Zell's approach to hiring was completely unconventional. He could not have cared less about Ivy League degrees. In fact, he said some of his worst hires came from the best schools. He wanted smart people, sure, but not some theoretical genius who would over-intellectualize every single problem. So what did he care about most? Energy and motivation. He wanted people with a fire in their belly, that internal drive to just get stuff done. This quote, it just perfectly captures his approach to deal-making. He saw this sign on a banker's desk way back in the 80s, and it became his mantra. He truly believed his greatest skill wasn't finding the yes,
but getting to know as fast as humanly possible. Being able to quickly identify a lost cause and just walk away freed him up to focus only on the opportunities that had real potential. Of course, not every deal was a home run. His most famous misstep was definitely the acquisition of the Tribune Company. So what went wrong? Well, in its simplest form, his team built the whole deal assuming that newspaper revenues would continue their slow, manageable decline of about 6% a year. Instead, the floor completely fell out from under the entire industry, and revenues plunged by 30%. The fundamental assumptions were just plain wrong, and no amount of clever financial engineering could fix a market that was fundamentally broken. And this leads to a really crucial lesson on failure. Zell knew he wasn't going to win every single time. He used to compare investing to baseball. If you get a hit 1/3 of the time, you're a Hall of Famer. His goal was just to be right 60 to 70% of the time. And this is the critical part, to make sure that when he was wrong, the loss was controlled. He always knew his downside. And finally, let's look at the personal philosophy that really underpinned everything he did. For Zell, you see, business wasn't separate from life. It was just an extension of his core personality, a personality that was maybe best exemplified by his lifelong passion for motorcycles. That is such a powerful statement. Zell was relentlessly forward-looking. He just didn't waste energy looking in the rearview mirror. He made the best call he could with the information he had at the time, and then he moved on. Win or lose, the focus was always on the road ahead. You know, people would ask him if riding these high-speed motorcycles all over the world was unsafe for a man with so much responsibility. And his answer was always simple. Riding was freedom. And that relentless pursuit of freedom, of living life entirely on his own terms, that was the real engine behind everything he did, both in business and in life. And so we end right where we began, with his single most important piece of advice. When you're looking at any opportunity, whether it's in business or in your own life, don't get seduced by the potential upside. Start by asking the tough, skeptical question, what could go wrong? If you can honestly answer that question, if you can quantify and contain that risk, then and only then are you ready to talk about the upside. And that right there is the very essence of the Grave Dancer's playbook. Let's talk about managing money. And I don't mean just a little bit of money, I mean a truly staggering, almost unimaginable amount. We're going to do that by looking at the world through the eyes of one of its most powerful figures, Mary Callahan Erdos. She's the person that some of the wealthiest people and institutions on the planet trust with their fortunes. So just how much are we talking about here? There it is, $4 trillion. Just let that sink in for a second. As the head of JP Morgan's Asset and Wealth Management, that is the amount of client money she and her team oversee. To put that into perspective, that's more than the entire annual economic output of Germany. So what's the secret? How do you manage a fortune on that scale? Well, you might think it's some super complex algorithm, but it's not. It all starts right here, with this idea. Her whole philosophy is that the real secret to managing wealth isn't about the numbers, it's about understanding people, their fears, their goals, their family dynamics. It's about listening, not just talking. So let's dig in and see how this actually works in the real world. All right, so here's how we're going to break this all down. First, we'll properly meet Mary Callahan Erdos and see how she got to where she is. Then we're going to define what wealth management actually is. Trust me, it's more than you probably think. After that, we'll get into her 3 core rules of money, explore the psychology behind it all, and then finally look at how she handles things when financial storms hit. Okay, first up, let's meet the trillion-dollar manager herself. Who is this person at the very top of one of the world's biggest financial powerhouses? Yeah, her resume is, well, it's pretty staggering. She's the CEO of JP Morgan's Asset and Wealth Management, a key member of the bank's Big Deal Operating Committee, and a top advisor to the big boss, Jamie Dimon. Her influence goes way beyond the bank, too. She even advises the New York Fed. This is someone who understands the global financial system inside and out. But what I find so fascinating is that her journey didn't start anywhere near a boardroom. Her story is really a masterclass in working your way up from the absolute bottom to the very, very top. It's a journey that started not with trillions, but with, balancing checkbooks. Her beginnings were so practical, so normal. Her first finance job? Balancing her grandma's checkbook for a couple of bucks. Her first real job was basically in the mailroom of an investment firm. She was the one delivering portfolio reports to the managers, and that's where she fell in love with the markets. From there, she went on to be the only woman in her math major program at Georgetown, which tells you a lot about her analytical mind, and then crushed it at Bankers Trust and Harvard. This is a path built on pure grit and curiosity, not on privilege. So this brings us to a really crucial point. What is it she actually does? The term wealth management gets thrown around all the time, but most people confuse it with something else entirely. Okay, let's be really clear about this. On one hand, you have asset management. That's all about managing investments, stocks, bonds, that sort of thing. But wealth management, that's the whole shebang. It includes asset management, sure, but it's about a person's entire financial life. We're talking mortgages, loans, planning for taxes, how to give money away, planning for the next generation. It is the full 360-degree view. I mean, just look at this list. This really shows you the scope of the job. It goes so far beyond just looking at stock charts. It's about setting up trusts and estates, planning a family's charity work, setting up college funds, even helping navigate the financial nightmare of a divorce. The wealth manager is like the central hub for everything. But that begs the question, right? If you're brilliant enough to build a massive fortune, why would you need this kind of help? Well, Mary has the perfect analogy for this. She says most of her clients made their money by being an absolute genius at one thing, like, say, building a tech company. But keeping that wealth and growing it requires you to be great at many things. A world-class heart surgeon isn't going to try to perform brain surgery on themselves, right? Same idea. A brilliant entrepreneur needs a team of specialists to manage the incredible complexity of their finances. Okay, now let's get into the practical advice. Erdos has a philosophy that really boils down to 3 simple but incredibly powerful rules for handling money. And these work whether you have $100 or $1 billion. Here they are. Rule number 1, don't lose it. It sounds obvious, right? But it means you figure out what you need to live the life you want, and you protect that capital at all costs. It's defense before offense. Rule 2, diversify. You've heard it a million times. Don't put all your eggs in one basket. But it's especially important when markets are going crazy and everyone thinks they can't lose. And rule number 3, be realistic. If some new investment promises returns that seem way too good to be true, they are. They just are. History is your friend here. And if you're wondering why these simple rules matter so much, look at this chart. This is what's called the performance gap. JP Morgan's research shows that over 20 years, a simple balanced portfolio returned about 6.5% a year. But the average person investing on their own, they only made about 3%. That massive gap comes down to one thing: emotion. We get swept up in the hype, the fear of missing out, so we buy high when everyone's greedy, and then we panic and sell low when everyone's scared. A disciplined strategy is designed to protect you from your worst enemy, yourself. And of course, the secret sauce that makes all of this work is time. Erdos always says that the single most powerful force in the universe of finance is compounding. Starting early, even with small amounts, and just letting it grow, that's the fundamental secret. It's the answer to almost every question about how to build wealth long term. All right, so that's the numbers side, but this brings us to the more complex and frankly more interesting part of the equation, the human side of the balance sheet. It's not just about what the money is earning, it's about what the money is for. Let's start with a really basic question. When you spend a lifetime building up wealth, where does it all eventually end up? When you get right down to it, there are really only 4 places it can possibly go. And here they are. You can spend it on yourself, you can give it to your family and your heirs, you can give it away to charity, or you can give it to the government in taxes. That's it. A huge part of a wealth manager's job is to sit down with a family and help them figure out how they want to divide up the pie between these 4 buckets. There's no right answer, but here's the kicker. If you don't make a plan, someone else will make it for you, and that someone is usually the government. You know, someone once asked Mary if she feels like a psychiatrist sometimes, and when you think about it, it's a great question. Because family dynamics around money, wow, they can get really, really messy, full of tension and things nobody wants to talk about. And that's exactly where a great wealth manager proves their worth. They become the catalyst. They're the neutral third party in the room who can bring up the tough conversations about wills, about inheritance, about family values that are just too awkward or too emotional for a family to start on their own. They bring a calm structure to what could otherwise be total chaos. So, all these principles sound great when the sun is shining, but how do they hold up when the world is on fire, when markets are in free fall? Let's look at how her team navigates the absolute worst financial storms. During the 2008 crisis, and again during the pandemic in 2020, JP Morgan rolled out its crisis playbook. It starts with nonstop communication. Management meets 3 times a day. It involves digging deep, using this 5 whys technique to get to the real root of a problem. Like in '08, why are mortgages failing? Well, people aren't paying, okay? Why aren't they paying? Because their rates reset. Why did they reset? You just keep digging until you find the foundational issue. They use their massive global network to pull in information. And most importantly, they just hammer home that core message to clients. Stay focused on your long-term goals. Do not make emotional decisions. Trust the plan.
And the results of all that discipline? It comes down to one word: trust. At the absolute peak of the panic in 2008, when people thought the whole system might collapse, JP Morgan was seen as a rock. In fact, at one point, $1 billion a day was flowing into the bank. It's an incredible statistic that shows you when fear is everywhere, stability and a steady hand are the most valuable things in the world. So, what's the ultimate takeaway from all this? The principles they use to manage trillions of dollars, things like listening, planning for the long haul, diversifying, communicating, they're universal. Mary Colin Erdos's work really shows that true wealth management isn't just about managing money. It's about managing life. It's about legacy. It's about family. Which leaves all of us with a final question to think about. Wealth at any level comes with responsibility. So what's the most important financial conversation that you need to start?
George Soros. The name is legendary in finance, right? A guy who built a fortune in the billions. But what happens when a legend like that decides to step back? I mean, who do you possibly trust to take the reins of that kind of operation? Well, today, we're going to pull back the curtain on Soros Fund Management and really unpack the playbook of the person now in charge, CEO and Chief Investment Officer Dawn Fitzpatrick. She's the one tasked with steering one of the biggest fortunes on the planet.
Let's just kick things off with this quote, because honestly, it gets to the very heart of this entire story. In the world of high-stakes finance, you'd think you have to be perfect, that you can't afford to be wrong. But Fitzpatrick's whole philosophy is built on something much more real. It's about humility. It's about taking smart, calculated risks, and knowing that at the end of the day, winning isn't about a perfect record. It's just about being right a little more often than you're wrong. Let's keep that idea in mind as we go.
All right, so here's our game plan. First, we'll talk about the insane pressure of following a guy like George Soros. Then, we're going to dive into the world she operates in, this powerful, kind of secretive world of family offices. After that, we'll trace her own incredible journey to the top, get into the nuts and bolts of her investment philosophy, and finally, we'll boil it all down to her wisdom on what it actually takes to be a great investor.
Look, to really get what Dawn Fitzpatrick is doing, you have to appreciate the sheer size of the legacy she's managing. George Soros wasn't just some other successful guy on Wall Street. The man practically wrote the playbook for the modern hedge fund. His returns were legendary, his thinking was on another level. So much so that his every move was scrutinized by the entire market. He was the market, in many ways. That puts an unbelievable spotlight on whoever comes next.
So it all leads to this massive question, right? If you've spent a lifetime building an empire of wealth and a global philanthropic foundation, who do you hand the keys of the kingdom to? Who could you possibly trust? For Soros, the answer was Dawn Fitzpatrick, a deeply respected investor in her own right and the first person to ever hold both the CEO and the CIO job at his firm. That's who we're focusing on today.
Okay, so to understand her job, first we need to understand the kind of company she's running. It's called a family office, and it's not your typical investment firm. The way these things work has changed dramatically over the years, and it's absolutely crucial for understanding how Soros Fund Management operates right now.
So what is a family office? Well, at its core, it's basically a private, dedicated company built for one reason: to manage the massive wealth of a single, ultra-rich family. You can think of it like a personal mission control for everything: their investments, their charity work, even legal stuff. It gives them total control and complete privacy. But here's where it gets really interesting. Not all family offices are the same. You've got the old money style, like for the Rockefellers. Their main goal was always preservation. Just don't lose the money, keep it safe for the next generation. But today's family offices, the new money ones, built by people like Michael Dell, they are engines of wealth creation. They're aggressive, they're hungry, and they are major players on the world stage. And Soros Fund Management, it is squarely in that modern, powerful camp.
So, how in the world do you get tapped for one of the most coveted jobs in all of finance? Let's take a look at Dawn Fitzpatrick's journey. It's a really great story of finding a passion early, a ton of hard work, and just refusing to be sidelined in what has always been a man's world.
This wasn't some career she just stumbled into later in life.
The story goes it started when she was a kid. A neighbor actually taught her how to read the stock tables in the newspaper. And by the time she was 12, she'd read the Wall Street classic Reminiscences of a Stock Operator, and that was it. She was totally hooked. The die was cast really early on.
And long before she ever got the call from Soros, she had already proven she could handle responsibility on a massive scale. Get this, at UBS Asset Management, she worked her way up to become the head of investments, where she was responsible for a portfolio of more than $500 billion. So yeah, Soros wasn't taking a gamble here. He was hiring a proven heavyweight.
And her career path just lays it all out. After graduating from Wharton, she didn't go to some cushy bank job. She started in the rough-and-tumble trading pits of Chicago. We're talking a real trial-by-fire environment, where your performance is all that matters. And, well, there weren't a lot of women there, but she crushed it. And when UBS bought her firm, she just kept climbing, all the way to that top investment job before making the historic move to Soros.
Okay, let's get into the core of it. We've got the background, we know her story. So the big question is, how does she actually do it? How does Dawn Fitzpatrick invest all those billions? What's the strategy?
She is basically playing the game with 4 huge advantages that most investors can only dream of. First, a long-term horizon. They don't have to sweat quarterly returns, which means when markets get chaotic, they can run towards the fire while everyone else is running away. Second, a super broad mandate. They can invest in anything, anywhere in the world. Stocks, bonds, private companies, you name it. Third, flexibility. They can make the investments themselves or hire the best outside managers to do it. And finally, a single client, the foundations, which just makes everything simpler.
And this is how she's using that flexibility. She has made a major shift to bring more of the management in-house. 70% of their stock market exposure and a whopping 95% of their private credit deals are now managed by their own team. Why? Because it lets them find opportunities in what she calls the white spaces, those unique deals that fall between the cracks of traditional funds. The only big area they still farm out is private equity and venture capital.
So how do they even know if they're doing a good job? It's not about hitting some random number each year. Fitzpatrick actually thinks that's dangerous. Instead, they have this really tough 3-part test. First, they measure themselves against their peers, the big university endowments like Harvard and Yale. Second, they compare their results to a super simple passive portfolio of stocks and bonds, just to prove they're actually adding value. And third, they have to beat a custom benchmark set by their own internal committee. It's a high bar. And let's not lose sight of the why behind all of this. This isn't just about making a number on a spreadsheet go up. This entire complex investment machine has one ultimate goal: to generate over $1 billion every single year to fund the Open Society Foundations and its work on human rights all around the globe. That's the real-world stakes behind every trade. All right, for our final section, let's zoom out and see what we can learn from all this. Fitzpatrick has spent her entire career studying markets and studying other investors. So what does she think it takes? What are the absolute core qualities you need to be a great investor? For her, it really boils down to these 4 things. 1, endless curiosity. You have to always be asking why. 2, self-awareness. You got to be brutally honest about what you're good at and what you're not. 3, confidence. To make real money, you have to bet against the crowd, and that takes guts. And number 4, humility. This is the big one. It's the discipline to know when you're wrong, admit it, cut the losing bet, and just move on. It's that tension between confidence and humility. That's the real secret sauce.
Now here is a fantastic piece of practical advice. She says that too many people focus on how much money they want to make. The much more important question is understanding your drawdown tolerance. In plain English, how much can you stand to lose before you completely freak out and panic? Because if you don't know that number, you are setting yourself up to sell at the absolute worst possible moment.
This is where her thinking gets so interesting. Take a look at how she judges other money managers. A manager who claims every single idea is a perfect 10, that's a red flag. But check this out. A manager who is making way more money than you'd expect can also be a red flag. It might mean they're taking some crazy risks you don't know about. On the flip side, losing money for the right reasons, like sticking to a solid strategy during a downturn, that can actually be a green flag.
So when you put it all together, what it really comes down to is a mindset. It's about having intellectual honesty. A great investor respects the market, knows it can be unpredictable. They stay open-minded, and most importantly, they don't get so married to their own opinion that they ignore the facts when the facts change. They adapt.
And this brings us right back to where we started this whole conversation. There's this myth out there that to be a successful investor, you have to be perfect. You have to be right 100% of the time. But as Fitzpatrick reminds us, the reality is you only need a 51% batting average to do really, really well. For most people, the biggest barrier isn't the math, it's the psychology. It's the fear of being wrong that stops them from even stepping up to the plate.
And that's really the big takeaway for all of us, whether we're managing billions of dollars or just our own 401k. The goal isn't to be perfect. The goal is just to make smart, thoughtful bets and have the humility to learn from the ones that don't pan out. So, I'll leave you with that to chew on. If you only need to be right about half the time to win, what's really holding you back?
All right, let's talk about the world of high-stakes finance. You know, when you picture the people at the top, you probably think of a certain type. Ivy League economics degree, maybe some brutal years on Wall Street. It's a pretty well-worn path. But the story we're getting into today, it's not about that at all. It's about a first-generation college student, an art historian, who quietly became one of the absolute greatest investors of her generation. And that's really the million-dollar question, isn't it? How on earth did Paula Volant, a woman whose training was in meticulously restoring fragile, centuries-old works of art, end up managing billions of dollars and just crushing the competition? It's an incredible story about a different kind of training, a completely different mindset, and a revolution in the world of investing. So let's dive in. Now, to really get why Paula's story is so remarkable, you first have to understand the world she's stepped into. See, at the heart of every great university, there's this financial engine that we've all probably heard of, but let's be honest, few of us really get what it is: the endowment. So, what even is an endowment? Well, the easiest way to think about it is like a university's permanent savings account. It's this giant pool of donated money that's invested to grow and grow over time. But here's the key. The school can't just go out and spend the original donation. Nope. Instead, it spends just a small, carefully calculated chunk of the investment returns each year. The whole point is for that fund to last forever, to provide a steady stream of cash for things like financial aid, research, and faculty year after year for generations to come. For a long, long time, these endowments were pretty sleepy. I mean, back in the early 1900s, you had these funds just sitting in super safe, low-return bonds. But then things started to pick up. In the 40s, a guy at Harvard started dipping a toe into the stock market. Then the 70s came along with this total return idea, which was a huge deal. All of a sudden, schools could spend their gains, not just the interest. But the real earthquake, the thing that changed everything, hit in 1985. That's when a man named David Swensen took over Yale's endowment and basically tore up the old rulebook. David Swensen, this guy is an absolute legend in the investing world. He pioneered this whole philosophy that became known as the Yale model, and his results were just mind-blowing. Over 36 years, he delivered a return of nearly 14% a year. Now, get this, that generated an extra $50 billion more than the average university would have made. He became the undisputed gold standard. So what was his secret? What was the magic trick? Well, it was a pretty radical idea at the time, a heavy focus on what are called alternative assets. Swensen's genius was realizing that if you invested in these less common, harder to sell things, like private equity, venture capital, real estate, you could find some real bargains and get paid a premium for it. Now, back then, people thought this was crazy risky, but his results proved it was nothing short of brilliant. And he ended up training a whole generation of investors in this model, including, you guessed it, our protagonist. And this is where the story really takes a fascinating turn. Because the person who would become one of Swensen's most successful protégés, the one who would take his model and, you could argue, perfect it, well, she couldn't have come from a more different background than your typical Wall Street star. Just look at this. The contrast is wild. On the left, you've got the standard playbook. Economics degree, grind it out in investment banking, maybe do a stint at a hedge fund, then get that fancy finance MBA. And on the right, you have Paula Volant, art history and chemistry degree, career as an art conservator, running her own art restoration business. The two paths could not be more different. Her whole journey started with a moment of pure chance, As a first-generation college student, she was paying her own way through school, taking an art history class. And one day, she just happened to peer into a lab at Harvard's Fogg Art Museum. She saw a conservator about to dip this really delicate drawing into a bath of water. The woman looked up, saw her, and just said, "Don't just stand there. Come in and watch." That single moment, that one invitation, was the spark for an entire career. But here it is. This is the absolute key to the whole story. The skills she learned restoring priceless works of art were, unexpectedly, the perfect training for investing. Just listen to what she says here. Art conservation is all about deep, meticulous research. You have to piece together all these different bits of information, you test your ideas, and, most importantly, you think obsessively about everything that could possibly go wrong before you make a single irreversible move. I mean, that is a perfect description of world-class investment due diligence. So the bridge from the art world to the finance world, it was built out of a really practical need. She was running her own art restoration business and suddenly had to deal with payroll, insurance, all the complex finances of a small business. She realized she needed to learn this stuff, and that's what led her to apply to the Yale School of Management. And it was there, at Yale, getting a little restless during a break after her daughter was born, that she just walked over to the endowment office and knocked on David Swenson's door. Swenson saw something special in her, in that totally unconventional background. He hired her. And for 4 years, she learned the craft right from the master himself. And then she was ready for her own challenge. And that brings us to the heart of her legacy, what she pulled off at Bowdoin, a small liberal arts college up in Maine. So when she took the job of chief investment officer in July of 2000, this was the number she was working with, $465 million. Now look, to you and me, that sounds like a ton of money, right? But in the world of big-time endowments, it was a drop in the bucket. And her biggest problem? Nobody in the investment community had ever heard of Bowdoin. The best managers, the ones she needed to get into, were turning away billions. Why would they ever take a meeting with some small, unknown college in Maine? So how did she do it? Well, she hit the road, relentlessly. She was basically a salesperson for Bowdoin, selling the story and the mission just to get a foot in the door with those exclusive funds. She argued that picking the right manager was way more important than sticking to some rigid formula. She even created a farm team, betting on promising new talent before they got famous. And through it all, she managed risk with that same obsessive, laser-like focus she once used to restore a priceless painting. And the results? They were just staggering. After 21 years with her at the helm, that initial $465 million endowment had grown to $2.72 billion. That's almost a 6-fold increase. It was a truly historic run that put this little college on the global financial map. But here's the thing. It's not just the final number that's so impressive, it's who she beat along the way. For almost her entire time there, Bowdoin's returns were consistently in the top 10% of all college endowments. That means she was outperforming the biggest, the wealthiest, the most prestigious schools in the world. She regularly beat the Ivy League average, and yeah, a lot of the time, she even beat her old mentor at Yale. And that fact was not lost on David Swenson. In what has to be the ultimate sign of respect, he sent her a letter with this quote from Leonardo da Vinci: "Great is the student that excels the master." I mean, wow. That was the ultimate nod from the legend himself, a true testament to just how far she'd come. Okay, so what can we take away from this incredible success story? What's the core of the Volant philosophy? Well, it really seems to boil down to a few key principles: discipline, courage, and just plain independent thinking. One of the biggest lessons is her approach to mistakes. She says, first, you have to do the hard work to figure out if you really made a mistake in judgment or if it's just the market being crazy. But the moment you lose conviction in an investment, you have to decide and then you have to act. She says, I don't believe in waiting out mistakes. You seldom make your money back if you stay in. It's that disciplined, almost surgical approach to cutting your losses and moving on. And this all ties back to this core belief she learned from Swenson, which is captured perfectly in this quote from the economist John Maynard Keynes. Think about it. The pressure in finance is huge to just do what everyone else is doing. That way, if you fail, hey, at least you failed in the same way as everybody else. But real, lasting success, that often comes from taking the unconventional path, trusting your own research, your own gut, even when it goes against what everyone else is doing. Paula Vollen's entire career is basically a masterclass in the power of succeeding unconventionally. Which brings us to a final and really important question. Look, someone with her track record could have made so much more money running a private hedge fund. So why? Why stay in the world of nonprofit endowments for all those years? Well, the answer is all about the mission behind the money. See, those returns aren't just numbers on a page. They translate directly into the university's budget, into its soul.
At Bowdoin, an unbelievable 81% of all financial aid comes directly from the endowment payout, the money that Paula was responsible for growing and protecting. And that brings her story completely full circle. For Paula Volant, a first-generation college student who absolutely needed financial aid to get her own education, this mission was deeply, deeply personal. She wasn't just generating returns. She was creating opportunities. She was making sure that a world-class education was possible for students just like she had been. And that's a return on investment you just can't get at a hedge fund. In the end, her journey is just this powerful reminder that the most valuable assets we have are often the skills we don't even recognize as assets. It's about being curious, being incredibly diligent, and, as she says so beautifully here, just being open to those chance moments that can change your life. The art historian who mastered finance teaches us that the path to success is rarely a straight line. And sometimes the most unconventional background is the perfect preparation for true greatness. So when you picture a big university, what comes to mind? Lecture halls, maybe old libraries, sprawling green campuses. But behind all of that, there's this massive, often invisible engine that's running the whole show, a multi-billion-dollar endowment. These are just immense pools of capital. And today we're going to pull back the curtain on how they actually work by diving into the strategy of one of the absolute sharpest minds in the game, Kim Liu, the woman steering Columbia University's entire financial future. And this quote right here, it really sums up the entire philosophy we're going to dig into. We're building for the long term. See, this isn't about hitting next quarter's numbers or chasing some hot stock tip. This is about making sure an institution can thrive for centuries. And when that's your mindset, it changes absolutely everything about how you invest. All right, so here's our game plan. We'll kick things off with the mind-boggling scale of these funds and what they're even for. Then we'll get into this whole idea of investing for forever. We'll step inside the mind of a chief investment officer, trace Kim Liu's unbelievable journey, and finally, we'll look at how she's thinking about the really complex future of our global economy. Okay, let's dive right in. First up, what exactly is a university endowment for? Because it's so much more than just a big number on a spreadsheet. It's the financial lifeblood that powers the whole institution, from cutting-edge research to day-to-day student life. So get ready for this number. This is what Kim Liu is responsible for every single day. $14.3 billion. That is the size of the Columbia University endowment. I mean, just let that sink in for a second. Managing that kind of money isn't just a job. It's this profound responsibility to generations of students, faculty, and really, the future of human knowledge itself. So where does all that cash actually go? Well, that $14.3 billion isn't just sitting in some bank vault. It's out there working. It's providing scholarships that open doors for students who might not otherwise have a chance. It's funding that kind of groundbreaking research that can literally change the world. It builds the new libraries and labs. And, as Kim Liu sees it, it's a powerful tool to take on huge problems like climate change and to educate the next wave of leaders who are going to have to keep solving them. Endowments haven't always been these financial juggernauts. Their massive growth over the past few decades is really thanks to a fundamental shift in strategy. It was a move away from the old-school conservative playbook and into this whole new world of what the industry calls alternatives. So what in the world are these alternative investments? Well, simply put, they're everything that's not a traditional stock or bond that you could buy on a public market. We're talking about venture capital, private companies, buyout funds, that kind of stuff. For a long time, this was seen as this exotic, risky adventure. But now, it's the core of the playbook. And why is that? Well, because these long-term, less liquid investments are a perfect match for an institution whose time horizon isn't measured in years, but in centuries. And when you put these two approaches side by side, the difference is just night and day. On one side, you've got traditional investing. It's liquid, you can sell it easily, it's generally lower risk and often pretty passive. On the other side, you've got alternatives. Your money is tied up for years, sometimes a decade or even longer. The risks can be higher for sure, but the potential returns are too. And this is the key part. It requires active, hands-on management. You're not just buying a piece of a company. You're partnering with the people who are actually building it. Now, this didn't just happen overnight. It was a slow burn. What started out as adventure capital way back in the 40s, and then buyouts in the 70s, it was seen as pretty risky stuff. The real game changer was in 1979. That's when the U.S. government basically gave pension funds the green light, calling these investments prudent. And that one decision, it opened the floodgates.
It turned alternatives from this tiny niche into the $11 trillion plus industry it is today. All right, so we've got the what and the why down, but now let's get to the really fascinating part, the how. How does someone like Kim Lu actually decide where to put billions of dollars for the long, long haul? This is where the real art and science of the job comes in. So, how does she pick who gets to manage a piece of this massive pie? Her four-step process is, frankly, brilliant, mostly for what she looks at last. See, most people would jump right to the track record, right? How did they perform in the past? But Lu starts with strategy. Is this idea different? Can it really win? Only then does she look at the organization. And this is so important, the alignment. Are these people true partners? Do they share our values? And only after all of that is checked off does she finally look at the track record, not as a guarantee, but just as confirmation that this team has the skills to pull it off. Okay, this is a really key point. You might think $1 billion is $1 billion, but how you manage it depends entirely on the mission. Before Columbia, Kim Lu worked at big foundations like Carnegie and Ford, and she gets this crucial difference. For a foundation which lives and dies by its endowment, the number one enemy is liquidity. They have to have cash ready to pay out their grants. But a university is different. It's got tuition, gifts, other income. For them, the biggest monster under the bed is volatility. A huge market crash could put the university's entire budget, with all its fixed costs, like salaries, in serious jeopardy. It's a subtle difference, but it shapes every single decision. And that idea of mission leads us straight to this next point, which is absolutely critical in today's world. Managing an endowment isn't just about chasing the highest possible return anymore. The investment strategy has to be aligned with the core values of the university itself. So for Columbia, that means a real focus on sustainability, which makes perfect sense given their work at the climate school. And it also means a strategic push for diversity, equity, and inclusion, actively looking for and backing a more diverse group of fund managers, people who better reflect the world we actually live in. So who is the person making all these high-stakes decisions? I mean, to really get her perspective, you have to understand where she came from. And it is a powerful, powerful story of intellect and resilience, and of breaking down doors in a world that wasn't always ready to open them. I mean, her journey is just incredible. We're talking about growing up in the housing projects of the Bronx, the daughter of a Chinese father and an African-American mother, and then crushing it at one of New York City's best public high schools. From there, it was on to Wharton and Harvard Business School. She started her career in banking, then moved over to the Ford Foundation and later Carnegie. And that's where she really mastered this whole long-term endowment model of investing. It's a path that gave her a completely unique perspective in a field that, let's be honest, is still dominated by pretty traditional backgrounds. All right, so no great investor just sits in an office looking at spreadsheets. They're always looking out at the horizon, right? Trying to figure out what's coming next. The massive forces that are going to shape the world over the next decade. So let's take a look at how Kim Lu is viewing the future. And let's kick it off with the elephant in the room for every investor these days, cryptocurrency. Is this thing just a fad, a flash in the pan, or is it a fundamental piece of our financial future? This is exactly the kind of new, messy, unpredictable territory that a long-term investor has to figure out how to navigate. And her perspective on crypto is so smart. It's not about being a hype man or a hater. It's totally strategic. First, she just acknowledges reality. It's here to stay. It's going to play some kind of role. So what do? The strategy is dabble, don't dive. You make small investments, not to get rich, but to learn, to meet the people who are experts in the space. She knows the volatility is just way too high right now for a big bet. For an institution with a forever timeline, this is about exploration, not allocation. And her focus isn't just on new technologies. Lu is also looking at these huge systemic risks. This quote, wow, it really gets to the heart of one of her biggest worries, the wealth divide. And notice, she doesn't just frame it as a social issue. For her, it's a fundamental threat to the economy itself. An economy can't be sustainable if nobody can afford to buy anything. It's a really powerful reminder that these decisions made in high finance are deeply connected to the health of our society. So when you look at how she views the future, it's like this perfectly balanced scale. On the optimistic side, you've got technology. She has this deep faith in brilliant people using tech and biotech to solve massive problems, like climate change and disease. But on the other side of the scale, you have the things that keep her up at night. Geopolitics, these unpredictable global conflicts, and the staggering levels of global debt. Those are the kinds of risks that are almost impossible to invest around. So after all this, after managing literally billions of dollars,
What does she think is the #1 most common mistake investors make? You might be surprised. It's not some crazy math error or a complex financial model gone wrong. It's a psychological one. It's following the herd and doing what everybody else is doing. Just chasing what's popular without stopping to ask if it's actually right for you. And that really brings it all back home, doesn't it? It leaves us with a really important question to chew on. Doesn't matter if you're managing $14 billion or just your own 401k, the fundamental challenge is the same. In a world that is constantly screaming at us to follow the crowd, how do you find the courage and the discipline to think for yourself, to analyze the risks on your own terms, and to build for your own long-term future?
All right, today we're going to pull back the curtain on an investor who is, and I'm not exaggerating, a living legend to some of the greatest financial minds in the world. But here's the twist. You've probably never even heard his name. We're talking about Seth Klarman. So why should you care? Well, how about this number? For nearly 4 decades, Klarman's firm, the Baupost Group, has cranked out a compound annual return of over 15%. I mean, that is just a staggering record over that long a period. And he's done it quietly, consistently, and completely out of the limelight. And this quote right here, this is the whole ballgame. It's the key to understanding how he thinks. See, for him, investing isn't just about spreadsheets and numbers. It's about understanding people, our greed, our fear, and all the crazy, irrational things that drive markets. It's a perfect blend of cold, hard math and the guts to go against the herd. So here's what we're going to do. We're going to unpack his entire philosophy. First, we'll get to know the man himself. Then we'll dive deep into his core method, value investing, and see how it holds up today. Then we're hitting the big one, the margin of safety. After that, we'll break down his 5 key principles and wrap it all up by looking at the investor's mindset that makes it all possible.
Okay, so first up, just who is this guy? Klarman has this almost mythical status, and honestly, it's because he actively avoids the spotlight.
You know, while you see other big-name investors all over TV and social media, Klarman is known as the investor's investor. And that's not some title he gave himself. It's what other top investors call him. It's a reputation that you earn in the trenches. He keeps a low profile on purpose. He's all about the work, not the fame, which of course just makes people want to hear from him even more.
And get this is how much demand there is for his wisdom. He wrote one book, Margin of Safety, way back in 1991. It's never been reprinted, it's totally out of print, and if you want to use copy today, it'll set you back thousands of dollars. It's become this legendary, almost underground text for serious investors.
Okay, so we've met the man, now let's get into his method. At its very core, his entire strategy is built on one simple, powerful idea: value investing.
So what is it really? Well, it's not about chasing hype or what's hot right now. Klarman's own description is the best I've ever heard. It's about trying to buy dollars for 50 cents. It's that simple. You figure out what something is actually worth, its intrinsic value, and then you wait with incredible discipline until the market freaks out and offers it to you at a massive discount.
Now, here's what's really interesting. When you look at the skills required, it's not about being a math whiz. These are character traits. It's about patience, the ability to just sit and wait for the perfect pitch. It's intellectual honesty, which means you can admit when you're wrong. And it's a deep curiosity, always asking why and connecting dots that other people miss. This is the real foundation.
But look, that original idea of value investing is almost a century old. So the big question is, how does a classic approach like this actually work in today's crazy, high-speed global market?
Klarman's take on this is crystal clear. The tools? Oh yeah, they've changed. We've got supercomputers, AI, big data, things the pioneers of this stuff couldn't have even dreamed of. But, and this is a big but, the one thing that hasn't changed an inch is human nature. Greed and fear are timeless. They're what cause markets to get irrational and create those bargains in the first place. The players have better calculators, but the game is exactly the same.
And because of that, a modern value investor has to be incredibly flexible. Klarman's not just sitting there picking stocks. He's applying that dollar for 50 cents principle to absolutely everything. It could be distressed real estate, a private business that needs cash, or some complicated investment that everybody else is too scared or lazy to understand. Value is value, wherever you find it.
All right, this brings us to it.
The single most important concept in Seth Klarman's entire world. Seriously, if you remember just one thing from all of this, make it this.
So, what on earth is a margin of safety? It's the title of his famous book for a reason. It is the absolute bedrock of everything he does.
The definition itself is so simple, but it's incredibly profound. It's the gap. It's the space between what an asset is really worth and the price you actually pay for it. It's your buffer against a future that you can't predict. Like Klarman says, you're building in room for bad luck, for mistakes, for things to go wrong, because guess what? They will.
And here's the magic of it. It protects you in two ways. First, there's the obvious financial shield. If you're wrong, you don't lose as much. But the second part is maybe even more important. It's a psychological shield. When markets are in a free fall and everyone is panicking, having that margin of safety is what keeps you calm. It allows you to be the one who acts rationally when everyone else is frozen in fear.
So, how do we actually put all this into action? Well, Klarman basically has a 5-point playbook that his firm lives by. Let's run through it. First, you have to play the long game. Think in years, even decades, not days or weeks. Second, you got to be flexible, ready to hunt for value anywhere it might be hiding. Third, and this is the big one, be risk-averse. That means being absolutely obsessed with your margin of safety. Fourth, be disciplined, not just when you buy, but also knowing when to sell. And finally, none of it works unless you think for yourself and are willing to look like you're wrong for a while.
Okay, last section. Let's zoom out from the specific rules and look at the bigger picture, the mindset that makes this kind of long-term success even possible. And this is so crucial. This isn't about some lone genius making brilliant calls. Klarman constantly talks about building a team, a culture, and most importantly, a consistent process. Why? To get rid of what he calls noise, all the random emotions and biases that mess up our decisions. A good process means you make decisions the same way on a good day as you do on a terrible day. It's about system over impulse.
And it's also about the person behind the portfolio. He's a voracious reader, and not just of annual reports. He reads history, biographies, politics, even fiction, because he knows you can learn a lot about human nature from a great novel. He's also a huge philanthropist, focusing on things like medical research, and one cause he's really passionate about, protecting democracy.
And this quote, I think, says it all. He applies that same long-term, value-based thinking to society itself. He's not looking for a quick political win. He's investing in the long-term health and stability of the whole system. He knows that's the foundation that allows everything else, including markets, to thrive.
Which brings us to a final thought. Seth Klarman built an incredible career by always looking for a margin of safety in the financial world. But that principle is so much bigger than just investing. In our world, which is just filled with constant noise and uncertainty, it's a question worth asking yourself. In your career, in your life, in the big decisions you make, where are you going to find your margin of safety?
Today, we're going to talk about a true giant of the financial world, Ray Dalio. But look, this isn't your typical success story. This is really a story about an absolutely catastrophic failure, a moment that brought him to his knees, but somehow became the very foundation for one of the most powerful investment machines the world has ever seen. And when I say powerful, I am not kidding. The machine he built is Bridgewater Associates. It is the largest hedge fund on the planet, managing over $150 billion. I mean, just let that number sink in for a second. It's a truly staggering amount of money.
So how do you do it? Well, to get there, you gotta get inside his head a little bit. And this quote, it really sums up his entire philosophy. Dalio's whole thing is that to win, you absolutely cannot follow the crowd. You have to be an independent thinker, you have to go against the grain. But, as we're about to see, that kind of boldness, it has to be balanced with something else entirely.
All right, so here's how we're going to break down his journey. First, we'll look at the incredible machine he built. Then, we'll rewind to his rebellious, unlikely start. We'll hit the core of the story, the one mistake that cost him everything. Then, the powerful formula he discovered in the wreckage, how he used that to build the Bridgewater machine, and finally, how those ideas became a philosophy for life.
So first things first, let's set the stage. To really appreciate what Dalio built, you have to understand the world he competes in, the high-stakes world of hedge funds.
The original idea, which goes all the way back to 1949, was right there in the name, a hedged fund. The goal was to use these really sophisticated strategies, like betting a stock will go down, that's called shorting, to protect or hedge your investments when the whole market decides to take a nosedive. Now, this is what makes them totally different from the mutual funds that most of us know. You can kind of think of hedge funds as the Wild West of the investment world. They're way less regulated, they use these really complex strategies, and they charge way higher fees. We're talking 20% of the profits sometimes. The whole structure is designed to attract the absolute sharpest minds to go after the biggest returns possible.
And in that Wild West, among all those sharp minds, Bridgewater is in a league of its own. In an industry where funds pop up and blow up all the time, Bridgewater hasn't just survived for almost half a century. It has consistently made more money for its clients than any other hedge fund in history. So the big question is, how on earth did Dalio pull off this kind of consistency and scale?
So how did he build this thing? Well, his path was anything but a straight line. You'd probably think the founder of the world's top hedge fund was some straight-A student with a perfect resume, right? Well, you'd be dead wrong. Just look at this timeline. It tells such a great story. He starts investing at 12, which is pretty cool. But then he's a self-described C+ student who just hated high school. He finally finds his passion in college, even gets into Harvard Business School, and then promptly gets fired from his next job after literally punching his boss on New Year's Eve. He said it himself, he was not a classic good employee. So by 1975, what choice did he have? He had to start his own firm, right out of his apartment.
And this quote right here, it gets to the absolute heart of how he thought back then. For him, investing wasn't some stuffy, serious profession. It was a game. He was totally hooked on the thrill of solving the puzzle and, winning. He admits he was naive, that the thought of losing money didn't even cross his mind. As he says, I learned about that later. And oh boy, was he about to get the lesson of a lifetime.
And this is where the story really turns. We're at the pivotal moment. The single decision that would tear down everything he had built and, in the process, change his life forever.
The year is 1982. Dalio had been on a roll. He correctly predicted that Mexico was about to default on its debt, and it made him feel invincible. He was convinced that American banks had loaned way too much money to other countries and the whole system was about to collapse. So he went all in. He made a very, very public bet that a massive depression was right around the corner. Yeah. Well, the market had other ideas. The very day he expected the collapse to begin turned out to be the exact bottom of the stock market. The Fed stepped in, interest rates fell off a cliff, and the market took off on one of the biggest bull runs in history. Dalio's big, confident bet wasn't just wrong, it was catastrophically, spectacularly wrong.
And the personal cost of that mistake was just devastating. He didn't just lose his clients' money, he lost all of his own. He had to fire every single person who worked for him. It got so bad, he was so broke, he had to go to his dad and borrow $4,000 just to pay his family's bills. This wasn't some abstract loss on a spreadsheet. This was a deeply personal, deeply humiliating defeat.
Now, for most people, this would have been the end of the story. Game over. But for Dalio, hitting rock bottom turned out to be the most important moment of his entire life. It was right there, in the ashes of his failure, that he found his most powerful tool.
This quote says it all. That failure taught him something profound. He realized his natural confidence, his audacity, was a gift, but it was also incredibly dangerous if it wasn't checked. The intense pain of being so publicly wrong gave him something new, a healthy fear. It gave him the humility he desperately needed to balance out all that confidence.
And out of that whole experience, he came up with a kind of formula. He realized that pain isn't just something to avoid, it's a signal. It's telling you something is wrong. And if you can just stop, reflect on that pain, and figure out what happened, you can pull out a lesson, a principle, that will keep you from making that same mistake again. This simple idea, pain plus reflection equals progress, became the engine for everything that came next.
And when he reflected on that 1982 disaster, two huge lessons came out of it. First, he realized his biggest mistake was being so sure he was right. From then on, he would have to actively go out and find the smartest people he could who held the exact opposite view, just to pressure test his own ideas. And second, he had to figure out how to structure his bets so that no single mistake could ever wipe him out again while still shooting for those big returns.
So now, armed with this whole new philosophy, Dalio didn't just try again. He decided to rebuild the entire game from the ground up. He set out to turn these hard-won personal lessons into a systematic, repeatable machine for making great decisions.
And he built that machine on three key pillars. The first was his new obsession, designing investments that could get you huge wins but protect you from huge losses. The second was absolutely revolutionary at the time. He started writing down all his decision-making principles as computer algorithms.
This let him test his ideas against history and, crucially, take his own emotions out of the equation. And third, he built a culture at Bridgewater he calls an idea meritocracy, a place based on thoughtful disagreement where the best idea wins no matter who it comes from.
And what's so fascinating is that these principles, which were born from a trading disaster, eventually grew into something much bigger. They became a whole philosophy for work and for life, and they tell us a lot about the man behind this incredible machine.
And here's something you might not expect from a titan of finance. Dalio says that his success has been due more to his 50-year practice of transcendental meditation than to anything else. He says it's what gives him the calmness, the clarity, and the creativity he needs to operate in what he calls the risky jungle of the markets and life.
So now, after all the financial success, Dalio's focus has really shifted. He feels a real responsibility, not just to make money, but to share the principles he learned on that incredibly painful journey. He sees it as his duty now to pass along these hard-won lessons to help other people on their own journeys.
And really, that leaves all of us with a pretty powerful question to think about. Dalio's story is proof that our worst mistakes don't have to be the end. In fact, if we can find the courage to really look at them, to reflect on the pain, they can become our greatest teachers. So what's that painful puzzle in your own life that might just be holding a valuable gem?
So what if I told you that one person could make $1 billion on a single idea? Well, that's exactly what we're talking about today. We're going to dive deep into the mind of Stan Druckenmiller, an absolute legend in the investing world. This is the guy who pulled off one of the most audacious trades in financial history. And in doing so, he pretty much rewrote the rulebook on what's possible in the markets. All right, let's jump right in. Yeah, you're seeing that right. $1 billion. And look, this wasn't his lifetime earnings or something spread out over decades. Nope. This was the profit from one single, highly concentrated bet. You gotta understand, back then, a number like that from just one trade, it was completely unheard of. It wasn't just a win, it was a thunderclap. It's what took him from being a really respected manager to a true global icon. Okay, but here's the twist. And this is where the story gets really, really interesting. The guy who pulls off this $1 billion trade then turns around and says the money isn't the big motivator. It's about winning, the competition, the intellectual game. So what on earth is going on inside a mind like that? That's the puzzle we're going to try to solve today. So here's how we're going to break it all down. First, we'll look at that famous $1 billion bet. Then we'll go back in time to see how he became an accidental investor. After that, we'll get into the nitty-gritty of that perfect trade. We'll lay out his core philosophy, the Druckenmiller doctrine, and we'll wrap up by digging into what really drives him, if it's not the money. All right, part one, the $1 billion bet. Let's set the stage. The year is 1992. Stan Druckenmiller is the lead guy for George Soros's famous quantum fund, and he spots something, an opportunity that pretty much everyone else is completely missing. He's about to go all in on a massive bet against the British pound. So to really get what's about to unfold, you need to know the cast of characters. First, you've got Druckenmiller. He's the mastermind, the strategist. Then you've got his legendary boss, George Soros, who's about to push him to be even more aggressive. Their target? The British pound, which Druckenmiller is convinced is way overvalued. And the whole thing is held together by a fragile thread, the powerful German Deutschmark, which is the anchor. Okay, so how did this guy even end up here? I mean, his journey to Wall Street was, well, it was anything but typical. You know, he wasn't one of those kids trading stocks from his parents' basement. Not at all. He was actually heading down a completely different path. So get this, he starts out as an English major. Then he goes for an economics PhD, but it just drives him crazy. He felt like it was all theory, trying to cram the messy, chaotic real world into these perfect little mathematical models. It just didn't feel real to him, so he drops out. Takes a job as a bank analyst in Pittsburgh. And just 4 years later, boom, he starts his own hedge fund, Duquesne Capital. You know, I love this quote from him. It just says so much. He doesn't see himself as this all-around genius. He's like, look, I have this one very specific talent, and I was just incredibly lucky to stumble into the one job on the planet where that talent matters. It's this amazing mix of, deep, deep confidence in his one skill, but also this real humility about everything else. All right, let's get back to the main event, the anatomy of that perfect trade. This was no lucky punt.
This was about seeing a huge structural crack in the foundation of the European economy. An opportunity so good, he himself called it a once-in-a-generation deal.
So here's the setup, and it's basically a tale of two completely different economies. On one side, you have Germany. After reunification, its economy is just booming. So their central bank does what you'd expect. They raise interest rates to cool things down and fight inflation. But then you have Britain, and their economy is in the dumps. It's really suffering. The problem is, because of the system they were in, Britain was forced to match Germany's high interest rates, and that was like pouring acid on an open wound. It was absolutely crushing their economy.
So you're probably asking, well, why couldn't Britain just lower its own interest rates to help itself out? And the answer is this little thing called a fixed exchange rate. The British pound was literally pegged to the German Deutsche Mark. It was a financial straitjacket. The best analogy I've heard is it's like Britain was trying to run a marathon, but its ankle was tied to a German sprinter. It just couldn't keep up. And Druckenmiller looked at this whole setup and thought, there's no way this can last.
And this is the key to the whole thing. It's what investors call an asymmetric bet. Druckenmiller did the math. He figured, okay, if I'm wrong about this, if Britain somehow manages to keep the pound propped up, what's my downside? The most he could lose was tiny, maybe 0.5% of the fund. But if he was right and the whole thing came crashing down, he stood to make 20%. It was an incredible risk-reward setup, a total no-brainer if you saw it.
So with that kind of setup, his conviction was just off the charts. He walks into his boss, George Soros' office, and lays it all out. His plan? To bet the entire fund, 100%. We're talking about a $7 billion position against a major world currency. This wasn't just a big bet. This was a bet the entire farm kind of moment. And this is where the story becomes legend. Soros listens to the whole pitch, and he doesn't tell Druckenmiller he's being too crazy. No, he tells him he's not being crazy enough. He basically said, if this is really a once-in-a-generation opportunity, then just betting the fund doesn't make any sense. Soros told him to use leverage and bet double the fund's value, 200%. The lesson was, when you have that kind of conviction, you don't just dip your toe in. You go all in and then some.
Okay, so that one incredible trade tells you almost everything you need to know about how this man thinks. It's a perfect case study. So let's unpack it and pull out the core principles. Let's build what you might call the Druckenmiller doctrine.
First thing to know, he's not just a stock guy or a bond guy. He calls his strategy his quiver of arrows. What that means is he's free to invest in anything. Stocks, bonds, currencies, commodities, you name it, anywhere in the world. And this is so important because it gives him incredible flexibility and discipline. If the stock market looks boring, he doesn't have to force a bad trade. He can just hang back and look for an opportunity somewhere else. So if you boil it all down, his playbook looks something like this. Step 1, develop a thesis. Try to picture what the world will look like 18 months out. Step 2, assess your risk-reward. You have to know exactly how much you can win versus how much you can lose. Step 3, and this is the big one from Soros, when you're sure, you go big. You have to size your bet to match your conviction. And finally, number 4, be flexible. The second the facts change and your big idea is wrong, you get out immediately. No ego allowed. So that last point about getting out when you're wrong, that brings up a really important question. I mean, how does a guy who bets this big actually manage risk? You'd be surprised. His answer goes against everything you read in the textbooks.
Okay, so most investors are taught to use this tool called a stop loss. It's pretty simple. It's an automatic order that sells your position if it drops to a certain price. The whole idea is to cut your losses before they get too big. It's like investing 101, right?
Well, listen to this. Druckenmiller calls the stop loss the dumbest concept ever. He says he's never used one in his entire career, and his logic is powerful. For him, the price moving against you is not the reason to sell. The only reason to sell is if the reason you bought it in the first place has changed, if your big idea is broken. See the difference? One is just reacting to the market's noise. The other is about your own thinking.
So we've looked at his strategy, his mindset, that epic trade. But it brings us back to that first question. If he's telling the truth and it's not about the money, then what is it about? What keeps a guy like this going after he's already won the game, 10 times over?
From everything he said, it really seems to boil down to a few things. First, it's the intellectual puzzle. He loves the challenge of it. Second, it's that raw competitive drive. He calls it a bit of a disease. He just loves to win.
Third, the market gives you a report card every single day. You always know where you stand. And finally, and this is a big one for him now, it's about growing his capital so he can give more of it away through his philanthropy.
And what I find so fascinating is how his investing philosophy bleeds right into his charity work. He does philanthropy exactly the same way he does investing. He doesn't just write 100 small checks. No, he finds a great leader, a great organization in a field he cares about, and then he backs them to the hilt. It's the same exact principle. Find something you believe in and bet big.
So that leaves us with this final big question, right? Druckenmiller's whole life is about betting big on your best ideas. And it really makes you think, in this crazy, uncertain world, what's the bigger risk? Is it that you'll make a big bet and be wrong? Or is the real risk that you'll play it too safe and that once-in-a-lifetime opportunity will just pass you by because you weren't bold enough?
You know, when you think about the titans of investing, names like Warren Buffett or Peter Lynch probably pop into your head. But then there's this other guy, someone from a completely different world, a man who didn't just play the game better than anyone else. He rewrote the entire rulebook using a language Wall Street had never really understood before, pure mathematics. This is the story of Jim Simons.
Okay, so let's just start with a number that frankly shouldn't be possible. For over 3 decades, Jim Simons' main fund, the Medallion Fund, averaged annual returns of over 40%. Now, to give you some context, that's not just good, that's not just beating the market. That is a level of performance that most people in finance would tell you is flat out impossible over that kind of time frame. And that really brings us to the core question, the big puzzle we're trying to solve here. How on earth does a guy who lived in the super abstract world of geometric theory, a man who admitted he knew next to nothing about investing, end up building what is probably the greatest money-making machine in the history of finance? To figure that out, we're going to have to trace his pretty incredible life story. We'll start by talking about why they call him the Quant King. Then we'll go way back to his roots as a pure mathematician. We'll look at a fascinating detour he took as a government codebreaker, see how he kind of stumbled into finance, and then get into how he built his market-cracking machine. And finally, we'll look at the legacy he leaves behind. So first things first, you've got to understand what made Simons so revolutionary. I mean, he wasn't just another investor. He was the guy who created a whole new way of doing things, a style that just turned Wall Street completely upside down. Yeah, he brought us what we now call quantitative investing. For hundreds of years, investing was all about human beings, your gut feeling, your intuition, reading a report and thinking, yeah, I like this company. Simons basically said, let's throw all of that out. He had this belief that buried in mountains of data were these tiny, almost invisible patterns, these little market inefficiencies that might only last for a few seconds. A human could never spot them. It's like maybe the system noticed that every time it rains in Paris on a Tuesday, one specific stock goes down by a tiny fraction of a penny for 3 minutes. No person would ever see that, right? But a computer could, and it could make millions of tiny profitable trades on that pattern. That was his whole idea, build algorithms to find these signals and trade on them automatically. But to even think of building a machine like that, you need a very, very specific kind of brain. And Jim Simons' brain wasn't trained in business school. It was forged in the world of pure abstract math, a world that is about as far away as you can get from the chaos of a trading floor. And look, he wasn't just decent at math. The guy was a genuine prodigy. His academic career was just meteoric. He gets into MIT at 17. He graduates in just 3 years at age 20. And by the time he's 23, he's got his PhD from Berkeley. I mean, that's a whole career's worth of school packed into just a few years. And it's not like he was just rushing through it. He was doing absolutely world-class work. One of his papers on geometry has been cited by other scientists over 1,750 times. That's a huge deal in academia. And in his classic, understated way, he just says, that was a terrific paper. So long before he ever even thought about a stock, he was already a giant in his own field. Now, here's where the story gets really interesting. Before he ever landed on Wall Street, his career took this wild turn that tells you a lot about who he was. He wasn't just a brilliant guy. He was a bit of a rebel and a man of principle. Right in the middle of the Vietnam War, Simons gets this top-secret job at the Institute for Defense Analysis, or IDA, and he's doing some of the most sensitive work you can imagine, cracking enemy codes for the U.S. government, a really high-stakes, high-pressure gig. But here's the thing. Simons was totally against the war.
So when a reporter from Newsweek comes to interview him, he's just shockingly honest about it. He basically says, yeah, I'm kind of doing a one-man protest. I'm focusing on my own math research, and when the war ends, I'll catch up on all the government work. So as soon as the reporter leaves, Simons tells his boss what he said. And his boss immediately picks up the phone to call the head of the whole operation, the famous General Maxwell Taylor. I mean, can you just imagine the silence in that office? You know this isn't going to end well. And it didn't. The response was fast. 5 minutes later, the boss comes out and just says, "You're fired." And in that one moment, you see everything. He picked his principles over this incredibly prestigious, top-secret job. It really shows you that non-conformist streak that would become so important later on. So his code-breaking career is over. He goes back to teaching at a university. But then, almost completely by accident, a door to this whole other universe just creaks open. He didn't go looking for the world of investing. In a way, it kind of found him. A company that he had helped some friends start down in Colombia started doing really well, and he ended up with a bit of cash. He takes that money and gives it to a commodities trader to invest. And this is the spark. In just 9 months, that trader turns his investment into 10 times what he started with. Now, for a regular person, that's just amazing luck. But for a mathematician like Simons, a result like that is a fascinating puzzle that needs to be solved. And you can see his analytical mind at work even in this very first trade. He didn't just throw money at the guy. He set very specific rules. Okay, the floor, a 30% stop loss, that's pretty standard. But it's the ceiling that's just bizarre. He told the trader to stop trading if he made 10 times his money. I mean, who does that? A mathematician, that's who. Someone who wants to hit pause, look at the results, and figure out why it worked, instead of just letting greed take over. So that crazy return, it got him hooked. He decided to leave the academic world behind and focus his mathematical brain on this brand new puzzle, the market. And this is the part of the story where he builds his legendary firm, Renaissance Technologies. And this slide really gets to the heart of what he did. You see, the old world of investing was all about making a few big, smart bets based on a person's gut feeling. Simon's new world was about making thousands, maybe millions, of tiny, statistically sound bets, all run by a machine that had no emotions, no biases, and a perfect memory of everything that had ever happened. So how'd they actually do it? Well, here's a look inside the famous black box. First, he hired geniuses, but he specifically looked for people from outside finance, physicists, computer scientists, linguists, people who could see the data with fresh eyes. Second, they gathered every piece of historical data they could get their hands on. Third, they just sifted through it all, looking for those tiny non-random signals. Fourth, they built the computer models to trade on those signals. And finally, step 5, they just let the machine run, totally hands-off. And let me tell you, the result was unbelievable. After years of tweaking and refining, the system just started printing money, producing those insane returns we talked about earlier. In fact, it became so successful that they did something unheard of. They kicked out all their outside investors. By 2005, the Medallion Fund had become a private club, open only to the employees who built and ran the machine. So when you look back, what's the real legacy of the man who solved the market? It's really not just about the money. It's about this core philosophy that he applied to everything, from his trading firm to the billions he gave away to charity. You know, when you ask him what his secret sauce was, he boils it down to these things. Yeah, obviously the math was crucial. Common sense helped. A little bit of good luck never hurts. But he always comes back to that last point. He insists that the real secret, the true engine of all that success, it wasn't an algorithm. It was the people. And this quote just says it all. The guy had absolutely no ego about his own intelligence. He actively went out and looked for people who were smarter than he was. He didn't just tolerate being challenged, he welcomed it. He understood that a room full of brilliant people collaborating could solve problems that no single genius, not even him, could ever solve alone. Which I think leaves us with this final thought. Yeah, Jim Simons was without a doubt a mathematical genius. But maybe his greatest genius wasn't in some complex formula. Maybe it was in his understanding that true game-changing innovation is a team sport. That it's less about being the smartest person in the room and more about having the wisdom and the humility to get all the smartest people in the room together, all working on the same problem. And, as it turns out, just like Einstein, he believed you could achieve all that without ever wearing socks. Which just goes to show you great minds really do think, and I guess dress, alike.
You know, in the history of Wall Street, there are some stories that just become legends. I mean, trades so big, so contrarian, that people talk about them for generations. But what if I told you the single greatest trade of all time was pulled off by a guy most people on the street had never even heard of? Well, this is that story.
Just take a second and look at this number. $20 billion. That's not a company's valuation. That's the profit that one man, John Paulson, and his firm pocketed from one big idea. This wasn't some lucky stock tip. No, this was a deeply researched, meticulously calculated bet against the entire United States housing market. And it's, without a doubt, the single most profitable trade in the history of finance.
So that's the big question we're going to unpack today, right? How did he do it? How does one person see this catastrophic financial hurricane forming on the horizon when literally everyone else was forecasting sunny skies? What was his secret? Let's dive in and find out. Okay, so our story really starts with the man at the center of it all, John Paulson. Now, before 2007, he wasn't a household name like some other Wall Street titans. He was a pretty quiet hedge fund manager. Successful, sure, but he operated in a very specific niche called risk arbitrage, basically betting on whether or not corporate mergers would go through. He did well, but he was about to do a whole lot better.
See, while the rest of the world was cruising along, blissfully unaware of the cliff we were all about to drive off in 2008, Paulson saw something else. He wasn't just nervous. No, he was absolutely convinced that the entire financial system was built on a foundation of sand, a house of cards just waiting for a breeze. And he didn't just see it, he bet everything on it.
To really wrap your head around the brilliance of this trade, you've got to understand the weapon he was aiming at, this ticking time bomb at the heart of the global economy, the subprime mortgage bubble. This was the system Paulson realized was fundamentally, fatally flawed. And it all began with this right here, the subprime mortgage. What is it? Well, it's basically a home loan given to folks with shaky credit, often with little or no money down. Now, while the housing market was red hot, this looked like a win-win for everyone. Lenders made money, people got homes. What could go wrong? Well, as it turns out, this was the very first crack in the dam.
And this is where the financial alchemy comes in. Wall Street built this incredible machine that could take thousands upon thousands of these super risky loans and, like magic, turn them into what looked like solid gold. So, step 1, banks hand out the loans. Step 2, they bundle them all together into these things called mortgage-backed securities. Step 3, they slice these big bundles up into different pieces or tranches. And finally, step 4, they sell these pieces to investors all over the world, stamped with a safe rating.
And here's the craziest part. Everybody bought it. The consensus, the groupthink on Wall Street was that these things were rock solid. I mean, they were being called as safe as treasuries. But Paulson saw the flaw. He understood that it didn't matter how fancy you got with the slicing and dicing. If you build something out of garbage loans, at the end of the day, it's still garbage.
So the big question is, how do you bet against that? How do you short the entire global consensus? Well, this is where the pure elegance of Paulson's strategy comes in. He didn't just flip a coin. He found what's known in the business as an asymmetrical bet.
You know, an asymmetrical bet is kind of the holy grail for an investor. It's any situation where your potential for profit is just massively, exponentially bigger than your potential for loss. You're basically risking a little to have a shot at making an absolute fortune. And Paulson, well, he'd been looking for a setup like this his whole career.
So let's look at the actual math of his trade. The risk, his downside, was pretty simple. A small fixed payment he had to make every year, kind of like an insurance premium. If he was wrong and the housing market kept booming, he'd lose that premium, a manageable loss. But the reward, the upside, was just staggering. If those bonds went bust like he thought they would, he stood to make 100, even 200 times his money. It was literally a heads I win, tails I don't lose much situation.
And here it is from the man himself. He summed it up perfectly. When you lay it out like that, it's just undeniable, right? It wasn't really a gamble at all. For him, it was a logical certainty. All he had to do was place the bet and wait for reality to hit everyone else.
The specific tool he used for this bet sounds complicated, but it's really not. It's called a credit default swap, or a CDS. Just think of it like an insurance policy. Paulson was buying insurance on these mortgage bonds. He paid his premium, and in exchange, if the bonds failed, if there was a default, the seller of that insurance had to pay him the full value of the bond. It was the perfect vehicle for his massive asymmetrical bet.
So what was it about John Paulson? What in his past gave him the ironclad conviction to make a bet that big against the entire world? Well, it was no accident. His entire career was almost a training ground for spotting what he would later call the mother of all credit shorts.
If you look at his career path, it's like he was collecting all the right puzzle pieces. Sure, Harvard Business School, partner at Bear Stearns, that's impressive stuff. But the real key is right there in the late 80s. He developed a very rare skill, shorting credit securities that he thought were mispriced. He had been practicing this exact type of play for almost 20 years before the big one came along.
All right, so after the trade played out, after the dust settled and his firm had made billions, everyone wanted to know, what's his secret? What can the rest of us learn from the guy who pulled off the greatest trade in history? Let's break down his playbook. First, you just have to appreciate the scale of this victory. It's truly hard to wrap your mind around. In 2007, an average hedge fund was thrilled to get a 10% return. Paulson's main credit fund? It was up almost 800%. There's a famous story about one of his investors calling him up, totally confused, thinking a 66% return for the month had to be a typo for 6.6. It wasn't a typo.
So what's his advice for us? Well, it's actually pretty straightforward. First, he says concentrate. Find an area you can know better than anyone else. That's your edge. Second, just avoid the get-rich-quick hype. Third, he actually thinks for the average person the best investment you can make is just buying your own home. And finally, and this is a big one, he says the most common mistake people make is just chasing things that are already popular and going up.
Which of course brings us to today. And given his advice about avoiding hype, you've probably got to wonder what he thinks about one of the hottest, most hyped asset classes of our time, crypto. Well, true to form, he's not a fan. He sees it as just another classic bubble with no real underlying value.
You gotta love how blunt he is. A limited supply of nothing. He just doesn't mince words. While so many people are seeing the future of finance, he's seeing a speculative frenzy. Interestingly, though, he also says that even though he believes that, it's too volatile to short. Unlike the housing market, there's no clear, clean, asymmetrical way to bet against it.
So, if he's not interested in crypto, where is he looking? What does the man who famously called the last crisis see as the big risk, or maybe the big opportunity on the horizon today? The answer, in a word, is inflation. He's convinced that the markets and the Federal Reserve are totally underestimating how sticky inflation is going to be. So while a lot of people were hearing the word transitory, Paulson was thinking it might be here to stay. And just like he did back in 2006, he has positioned his money to profit from the consensus being wrong.
And that really brings us full circle. The story of John Paulson is about more than just money. It's about having the courage to question the things that everyone else accepts as fact. It's about finding that once-in-a-lifetime opportunity by looking where nobody else is bothering to look. And it kind of makes you wonder, in our own crazy world of inflation and market hype, where is the next great asymmetrical bet hiding in plain sight?
So let's talk about private equity. You hear the term thrown around a lot, right? It's this huge kind of mysterious force in the business world. Well, today, we're going to pull back the curtain on it. And we're going to do that by looking at the incredible career of a true trailblazer, Sandra Horbach. Her story, it's more than just a success story. It's really a roadmap for how this entire industry grew up. From, a tiny little club into this absolute giant that touches pretty much everything we buy and use. Okay, let's just start with this quote. I've often been referred to as a unicorn, which is not a good thing. Now, when she says that, she is not bragging, not at all. She's pointing out something really important, a pretty harsh reality, actually. For most of her career, a woman at her level in finance was so incredibly rare, you might as well have been talking about a mythical creature. And that's why this quote is so perfect. It's our key, really, to understanding the huge challenges she faced and the kind of world she had to master.
All right, so here's the game plan for today. We're going to look at how she first broke into this world, a world that, let's be honest, was not set up for her. Then we'll get into the nuts and bolts of how those early deals were done. After that, we'll get into the story of her legendary turnaround of Gulfstream. And then we'll jump to today and see how different the whole playbook is now. And to wrap it all up, we'll pull out the key lessons from her amazing career.
Okay, first up, we gotta set the scene here. I want you to picture the world of finance in the 1980s. The buyout business. I mean, to say it was male-dominated is a massive understatement. It was more like a fortress, a boys' club for sure. We're talking about a time when a woman in a senior deal-making job was, well, it just didn't happen. It wasn't about a glass ceiling. For most people, there wasn't even a ladder to climb in the first place. You know what's wild to me? Her original plan had nothing to do with finance. She was at Wellesley studying Chinese, thinking she'd go into diplomacy.
But this was the 80s, right? The pull of Wall Street was just impossible to ignore. So she completely pivots, lands a job at Morgan Stanley, goes on to get her MBA from Stanford, and then bam, in 1987, she makes the jump. She gets a job at Forsman Little, which at the time was one of the absolute top dogs in the buyout game. And this is so important to understand. Back then, these firms were small, almost like secret societies. They weren't showing up on college campuses with fancy recruiting booths. No way. Getting in the door wasn't about having a perfect resume. It was about pure, raw hustle. She literally had to go bang on a lot of doors, as she put it, and talk her way into a job that didn't even exist yet. That's what it took just to get in the room. So she gets in. She's on the inside. But what did that even mean? What was the job? Well, she described it as an apprentice business. Basically, you learned by just watching the pros, these titans of the industry, like Ted Forsman. There were no manuals, no textbooks. The whole playbook was being invented, deal by deal, right in front of her. The main tool they used, the heart of this whole thing, was the leveraged buyout, the LBO. Let me break it down really simply. It's like this. You want to buy a company, but instead of using your own cash, you borrow a ton of money to do it, just a huge amount of debt. Then, the idea is you use the cash that the company itself generates to pay back all that debt. And if it all works out, in a few years, you own this valuable company free and clear. And get this, to see how crazy risky this was, look at this number, 90%. Typically, 90% of the money used to buy the company was borrowed. Just let that sink in for a second. The firm only had to put up 10% of their own money. It was the ultimate high-wire act, financially speaking. I mean, if you pulled it off, the profits were insane. But man, if you slipped up, there was absolutely no net to catch you. This right here, this really shows you how much the whole game has changed. Think of the 80s as the Wild West. You had fewer firms, so you could win a deal just based on your gut and your reputation. And how do you add value? You'd stock the board with powerful, well-connected people. Now, jump to today. It's a totally different planet. You have thousands of firms all fighting for the same deals, which means prices are through the roof. So that move from gut feel to data-driven, that wasn't just a style choice. It was survival. The old way just wouldn't work anymore with the prices they have to pay today. All right, this next part is a huge moment in her career. It's really the perfect case study of private equity at its absolute best. So the firm had this investment in Gulfstream Aerospace, and it was completely falling apart. I mean, cratering. This wasn't just some small hiccup. This thing was headed for a massive, catastrophic loss. So her boss, Ted Forsman, basically tells her, get on a plane, fly to Savannah, Georgia, walk into that company, and figure out how to fix it. So that was the challenge laid out in front of her. The company was just bleeding money. The original reason they even bought it? Totally shot. So the question is, how on earth do you save a company that's in a total nosedive? And not just save it, but turn it into one of the firm's biggest wins ever. This is way beyond just playing with numbers on a spreadsheet. This is like performing open heart surgery on a real live business. And she didn't do this from some cushy office in New York. Nope, she rolled up her sleeves and got her hands dirty. Her plan was super methodical. Step 1, she moved down there, spent months inside the company just figuring out if it could even be saved. The verdict? Yes, it could. So step 2, she pulled off this brilliant financial maneuver to buy them some time. Then came the really hard part. She fired the entire management team, the whole lot. She fixed a fundamentally flawed product, and then she played her ace. Just look at this list of names. I mean, come on. This is not your average corporate board of directors. You've got George Shultz, Henry Kissinger, Colin Powell. These are titans of global politics and the military. And they weren't just names on a letterhead. She said they became the best airplane salesmen you could ever imagine. The doors their names and their connections opened, well, you just can't buy that kind of access. This was the old school playbook done absolutely perfectly. So that Gulfstream story, that was a one-of-a-kind, boots-on-the-ground rescue mission. Okay, now let's hit the fast-forward button to today. Sander Horbach is now at the Carlyle Group, one of the biggest firms on the planet, co-heading their U.S. buyout team. And the game is completely different. It's not about these heroic one-off turnarounds anymore. Now it's a machine, a highly structured, data-obsessed, industrial-strength investment machine. This chart right here tells you everything you need to know about how tough the modern game is. It's a funnel, and it's brutal. Think about it. Her team might look at hundreds of possible deals in a single year. Out of all those, maybe 100 get a really serious, deep dive look. And out of that 100, how many do they actually buy? Maybe 6? Maybe 12? That's it. The needle they have to thread is just ridiculously small.
And the way you get through that funnel, it's not luck. It's an incredibly disciplined process. It all starts with deciding which specific industries to focus on. Then the teams go out and proactively hunt for companies. If they find something promising, it goes to a heads-up meeting for a quick look. If it passes that test, then the real work begins. Months of grueling, intense analysis, what they call due diligence. And only if a deal survives all of that does it finally go to the main investment committee for a yes or no. Every single step is designed to squeeze every last drop of risk out of the deal.
Okay, this right here is a stat that always blows my mind. In almost half of the companies they buy, they bring in a new CEO. Think about that for a second. Half the time, the person at the very top is replaced. That just goes to show you that for these big PE firms today, getting the right leader in place, the person who can execute their plan, it's not just a bonus, it's absolutely non-negotiable.
So remember that all-star board from the Gulfstream deal? All those famous statesmen? Well, what's the equivalent of that today? It's this, a huge team of in-house experts. I'm talking about people who are specialists in things like digital strategy, cybersecurity, supply chains, even ESG, which is all about environmental and social factors that investors care a lot about now. This is how they add value today, not just with connections, but by injecting this elite, specialized talent right into the companies they own. Okay, so after seeing this entire industry evolve over decades and climbing to the very, very top, what are the big takeaways? What does Sandra Horbach say it really takes to make it in this ridiculously competitive world? Let's get into the lessons. You know what's really interesting to me about this list? Yeah, of course, you gotta be a hard worker, you gotta be decisive, that's a divot. But look at the stuff she puts right at the top. Humility. Intellectual honesty, which is a fancy way of saying you have to be willing to admit when you're wrong about a deal, and a high EQ, emotional intelligence. In a world that looks like it's all about the numbers, she's saying it's actually these soft skills that make or break you. And this chart just drives that point home. What are the things that will absolutely kill your career in this business? Arrogance, laziness, not having integrity. At the end of the day, this whole business is built on partnerships with investors, with company managers, with your own team. If you can't work well with people, you're toast. It's an absolute deal breaker. For me, this quote really sums up her whole approach to business and to life, really. Complacency will destroy an organization. What she means is, your past successes mean nothing for tomorrow. The strategy that made you a winner 5 years ago, it's probably useless today. You have to always be changing, always innovating, always raising the bar for yourself and your team. The moment you sit back and think you've got it all figured out, that's the moment you start to lose. And this brings us right back to where we started, with her being called a unicorn. This table lays it all out, plain and simple. When she started back in '87, pretty much 0 women in leadership roles. And now? Well, it's still not great across the whole industry, but things are starting to change. Big investors are demanding it, and look at this, her own team at Carlyle is now 50% diverse, so the needle is definitely moving. Maybe the unicorn isn't quite so mythical anymore. So there you have it. We've watched this industry go from a handful of scrappy dealmakers taking huge risks to this global trillion-dollar machine that rebuilds companies from the inside out. And we saw it all through the story of one incredible career. So it all comes down to one big question, right? This industry has already changed so much over the last 40 years. What's next? What's the next big transformation for one of the most powerful forces shaping our world?
You know, when you think of private equity buyout, you probably picture those ruthless, cigar-chomping corporate raiders from the 80s, right? Well, that whole image is completely out of date. The game has totally changed. And the new face of it, well, it belongs to one man more than anyone else, Orlando Bravo. So let's get into it. This is the incredible story of how a tennis prodigy from Puerto Rico completely rewrote the rules for high-stakes buyouts.
So to really get what Bravo did, you've got to understand the world he walked into. Over on the left, that's the old-school barbarians at the gate model. You load up a company with just an insane amount of debt, like 90–95%. Then you sell off the good parts and just slash costs to the bone. It was hostile, it was often a mess. But on the right, that's the Thumb of Bravo way. A lot less debt, a laser-like focus on just one industry, and a strategy that's all about partnering up and actually growing the business, not just gutting it. It's a massive shift, from basically just playing with numbers to genuine hands-on improvement. All right, so here's our game plan for breaking down his incredible journey. We'll start with his status as the new buyout king. Then we're going to rewind all the way back to his competitive roots on the tennis court. From there, we'll dive into how he struck gold with software, we'll unpack his secret sauce, and then see how he scaled his firm into an absolute giant while also giving back in a huge way. And we'll wrap it all up with some really powerful lessons from the man himself.
So let's kick it off. Section 1. The new buyout king. And look, this isn't just about him being successful. This is about one guy pioneering a smarter, way more sustainable, and yeah, wildly more profitable playbook for an entire industry.
Okay, Section 2. From tennis court to boardroom. To really understand how he built his empire, we have to go back. Back to this, kind of unlikely place where his competitive fire was first lit. Long before he was looking at spreadsheets, he was staring down serves from guys like Andre Agassi and Jim Courier.
I mean, just look at this trajectory. It's all about pure ambition, right? It starts in a small town in Puerto Rico. From there, he goes to the most elite tennis academy on the planet, then to the Ivy League at Brown, and he caps it all off at the powerhouse combo of Stanford Law and Business. That relentless drive to get to the next level, it all started when he was just a little kid, and his mom took him to an exhibition match. It just sparked a dream.
But here's where you see that strategic mind of his show up really, really early. He was an amazing player, no doubt, but he was also a stone-cold realist. He saw the gap between being a top 40 junior player and being a true legend like Agassi. So instead of grinding it out on a long-shot pro career, he made a calculated pivot. He decided to use tennis as a tool to get a world-class education. That kind of pragmatic, clear-eyed thinking, it's the exact same mindset he uses in his investments today.
And he absolutely used that skill to his advantage. I love this story. To get summer jobs and make connections, he'd play tennis with the partners at these big firms. But get this, he never ever let them win. He wouldn't throw a match. He figured that showing them his true competitive fire, his edge, was way more valuable than just sucking up. As he put it, edge matters. That tells you pretty much everything you need to know about the guy.
All right, Section 3, the software gold mine. That same competitive edge sharpened on the tennis court was about to find the perfect place to dominate, an industry that he now calls, quote, the best business in the world.
So what is this magic little corner of the world he built his whole empire on? What exactly is enterprise software? I know it's a term that gets thrown around all the time, but Bravo's simple way of breaking it down is actually the key to his entire strategy.
He basically sees it in three main buckets. First, you've got the software that just runs the business. Your accounting tools, your marketing stuff. Second, there's all the code on the back end that manages the IT infrastructure, making sure all the data is flowing right. And third, and this is more important than ever, there's cybersecurity, all the software that protects a company's entire digital world. It's just a simple, really smart way to look at a super complex industry.
So why did he fall head over heels for this business? Well, just think about this model for a second. You build a product one time, and you can sell it over and over and over again for something like 90% gross margins. Your customers pay you up front before you even deliver the service. And at the time, these companies were usually run by tech geniuses who weren't really focused on the money side, so they were kind of undermanaged. And the real kicker? They were cheaper to buy than other businesses with the same kind of steady, recurring revenue. I mean, it was the perfect, overlooked opportunity.
But, and this is a huge but, it was not an easy sell. He figured all this out right after the dot-com bubble burst around 2000. So trying to get investors to pour money into a software-only fund was, in his words, nearly impossible. Everyone was terrified. His first fund was aiming for $1.2 billion. They barely scraped together $822 million. He's even said that if just 2 more investors had backed out, the whole thing would have been dead in the water.
But that conviction, it paid off. Which brings us to Section 4, Bravo's secret sauce. So this gets to the big question. How did he take these software companies and get these incredible returns when everybody else was running for the hills? And here it is, straight from the man himself. It's not just about crunching the numbers. It's about combining that deep, analytical rigor with a real understanding of people, how to motivate them, how to inspire them. See, anybody can copy a spreadsheet. You can't copy a great culture. And in the software world, where your main assets are the brilliant engineers, well, that human element isn't just a nice-to-have, it's literally everything.
And that whole philosophy leads right to this, his biggest break from the old buyout playbook. The traditional move was to come in, fire the CEO, fire the leadership team. Bravo's method is the exact opposite. He partners with the team that's already there, the people who actually built the product. And why?
Because in software, all the knowledge, all the vision, it's in the heads of those people. Firing them is like throwing away your best machine. His way builds trust and keeps the company's innovative soul intact.
So, did it actually work? Oh yeah. One of his very first software deals is the perfect example. It was a company that made software for distributors. By partnering with the management team and bringing in their expertise, they turned a company that was losing money into a total powerhouse. The result? They made 5 times their money in just 3 years. That is the kind of massive win that makes an entire industry sit up and pay attention.
Okay, this is probably my favorite story about his method. The CEO of that first company, he was a total skeptic after Bravo's initial pitch. He went home that night and told his wife, "These private equity guys are all full of it." But after working with them, after seeing the value they actually added, he became such a true believer that he personally invested his own money in Thumba Bravo's very next fund. You can't get a better stamp of approval than turning your biggest outer into your next investor.
So once they had a proven model, the next step was obvious: scale it up. Section 5, scaling and giving back. This is where the story goes from just impressive to absolutely mind-blowing. And it's also where Bravo starts to use his success to make a totally different kind of impact.
Just look at that number, $22.8 billion. That is how much money Thoma Bravo raised for 3 new funds right in the middle of the pandemic. And what's truly crazy is that they did it all virtually, not a single in-person meeting. That just screams volumes about the level of trust and the incredible track record he's built. Investors weren't betting on a firm handshake, they were betting on decades of top-tier, consistent performance.
So as his financial success just kept reaching these astronomical levels, a complete catastrophe brought his personal story right back home. In 2017, Hurricane Maria just devastated Puerto Rico. Seeing the island he grew up on in absolute ruins, that was the moment that pushed him into philanthropy on a massive scale. It's what led him to create the Bravo Family Foundation.
And this quote right here, it captures the powerful lesson he learned in that chaos. He flew a plane full of supplies into a small town and was just shocked to find nobody else there. No government help, no major aid groups, and he learned right then and there that you can't just wait around for someone else to fix a problem you care about. You have to step up and do it yourself. And that's the principle that now drives his foundation's work in Puerto Rico. And that brings us to our final section. Section 6, Lessons from a Titan. After a whole career built on seeing what other people miss, what kind of advice does Orlando Bravo have for anyone who wants to follow in those footsteps?
Well, his advice is pretty fascinating. For education, he's a huge fan of a broad liberal arts degree. And why is that? Because he thinks it teaches you how to think critically about people and systems, and that's more valuable than any formula. The most crucial skill, he says, isn't financial modeling, it's salesmanship, it's persuasion, the ability to get people to buy into your vision. The one trait you have to avoid? A need to control everything, because this business is messy and unstructured. And finally, when you're picking a place to work, look past the numbers and find a truly great culture.
And that really leaves us with one final big question. Bravo's genius was in finding that white space, an industry that was totally undervalued and misunderstood by Wall Street, and then building a system to completely own it. He found his in software 2 decades ago. So the question for us, for the next generation is, what's next? What's that overlooked, undermanaged industry out there that's just waiting for its own Orlando Bravo to come along and change the entire game?
You know, when a building's on fire, what do most people do? They run out. That's just common sense. But what if that building was a company? And what if instead of running away from the smoke, you were one of the few people running towards it? Because you knew there was a massive opportunity inside. Well, that's the completely counterintuitive world of distressed debt investing. It's a strategy that's literally built on finding profit in the one thing the market fears most: total failure. And that quote you just saw from one of the pioneers, Bruce Karsh, that's the whole game in a nutshell. It's this powerful idea that your biggest enemy isn't a bad balance sheet, it's your own emotion. And here's the key takeaway we're going to unpack. The real opportunity isn't the company's failure itself, it's the market's fear of that failure. That's the secret sauce. So, here's our game plan for this explainer. First, we'll get a handle on what distressed debt actually is. Then, we're going to see how it was all born from the corporate chaos of the 1980s. After that, we'll walk right through the investor's playbook, step by step. We'll look at the exact moments they choose to strike, explore the unique mindset you need to pull it off, and finally, we'll take a peek at what the future might hold. Okay, so let's start with this central question, this idea of investing in failure. I mean, who are these investors who look at a crisis and don't see a catastrophe, but a once-in-a-generation buying opportunity? And more to the point, what in the world did they know that the rest of us don't? You know, at its core, the definition is actually pretty simple. A distressed debt investor is just buying the loans or the bonds of a company that has either already gone bust or is circling the drain. The people selling this stuff, they're usually panicked. They are desperate to get anything they can before it all goes to zero. And that desperation, that fear, well, that's exactly where the opportunity begins. To really understand where this all came from, we need to kind of hop in a time machine. Let's go back to the wild, high-leverage world of the 1970s and 80s. This was a time when a brand new type of corporate rating was taking Wall Street by storm. And it was all about the leveraged buyout, the LBO. And the concept was just insane. You could buy a massive company using almost none of your own cash. Seriously, in those early days, you might put down just 1 to 5% of your own money and borrow the other 95 to 99%. The bet was that the company's own profits would be enough to pay back those huge loans. And when it worked, oh man, the returns were incredible. But when it didn't, well, you had the perfect recipe for a complete disaster. And that disaster was the perfect breeding ground for a new kind of investor. See, a company carrying that much debt is walking a tightrope. The tiniest little economic downturn, and suddenly its cash flow can't cover the payments. Boom, the company defaults, and all that debt, which was once worth 100 cents on the dollar, is now being sold off for pennies. That's how this market was born. Okay, so we know where these opportunities come from, but how does an investor actually turn a failing company's debt into a huge win? Let's open up the playbook. We'll use a simple example. Let's say a company, we'll call it Acme Manufacturing, gets bought for $100 million. Now, you gotta understand, this isn't just one big pile of money. It's better to think of it like a layered cake of risk. At the top, you've got $40 million in equity. That's the owner's skin in the game. Then you have 2 layers of debt, $30 million of what's called senior debt and another $30 million of junior debt. And the difference between these 2 types of debt is absolutely everything. Senior debt is kind of like a mortgage on your house. It's secured by the company's actual stuff, its buildings, its machines. If things go wrong, they are first in line to get paid back. But junior debt, well, that's unsecured. It's much riskier, so it pays a higher interest rate. But, and this is the key, these lenders only get paid after the senior guys get all their money back. So for an investor who wants to take control, this riskier junior debt, that is the prime target. So when our fake company Acme Manufacturing starts to get into trouble, who do you think freaks out first? You got it? The junior bondholders. They see the writing on the wall and they just rush for the exits, willing to sell their $30 million worth of bonds for maybe $15 million, 50 cents on the dollar, just to get something back. That wave of pure market panic is what creates the deep discount, and that discount is the investor's front door. And here's the real magic trick. This isn't just about buying low and hoping it goes up. The ultimate goal, the masterstroke, is to turn that debt into ownership. The investor buys up a controlling chunk of that cheap junior debt. Then, when the company is restructuring, they've got a powerful seat at the table. And their play is to say, hey, instead of that $30 million you owe us, which we all know you can't pay, just give us ownership of the new cleaned-up company. They swap cheap debt for valuable equity. And in doing so, they take control and help turn the whole thing around. Now, this playbook isn't just some theory in a textbook. Oh no. It has been used with incredible precision and massive success during pretty much every major financial crisis we've seen. The history of this strategy is really a history of capitalizing on total chaos. I mean, just look at this timeline of Bruce Karsh's career. It's basically a highlight reel of financial panics. The early 90s saw the collapse of all those original LBOs. Then you had the Asian financial crisis, the dot-com bubble bursting, the huge global financial crisis in 2008, and of course the pandemic panic in 2020. Every single downturn, every wave of fear created a brand new ocean of opportunity. And this right here gives you a perfect sense of the kinds of returns we're talking about. During that Asian crisis, the fear was so thick you could cut it with a knife. And because of that, you could buy the bonds of Samsung Electronics, already a global giant, and lock in a 20% annual yield. Think about that. This wasn't some tiny failing business. It was a blue chip company caught in a regional panic. You just had to be willing to buy when everyone else was convinced an entire continent was going down the drain.
And just look at the scale, the sheer guts you need during a true global meltdown. In Karsh's own words, in those 14 weeks after Lehman Brothers collapsed, when it really felt like the entire financial system might just end, his firm put over $5 billion to work. That's about $400 million a week, while the world was in a state of absolute sheer panic. That takes a lot more than just money. It takes an unbelievable amount of conviction.
So that brings us to what might be the most critical piece of this entire puzzle, the psychology. I mean, the numbers and the legal rules, they're complicated, sure, but you can learn them. The real test, the real challenge, is mastering your own emotions and forcing yourself to think differently from everyone else. You know, when you hear the term distressed debt, you might picture that stereotypical vulture investor, right? Some tough, aggressive guy who loves to yell and sue people. But the reality, at least according to Karsh's method, is the complete and total opposite. He says his approach is low profile, calm, even friendly. He tries to avoid messy court battles, preferring to build relationships and work out a settlement. He doesn't go on TV and brag. In fact, for business reasons, he actively avoids the spotlight.
And this quote just reframes the entire role. The pitch isn't about profiting from other people's misery. It's about being a problem solver. It's about taking a good company that's drowning in bad debt that probably shouldn't have been there in the first place, and giving it a second chance at life. By converting that bad debt into a solid foundation of equity, you can actually restore the company's health and, in the process, save a lot of jobs. So when you boil it all down, the real skill set here is this rare combination of traits. You need the emotional discipline, the iron stomach, to buy when every part of you is screaming to sell. You need that contrarian wiring to see value where everyone else sees a dumpster fire. You absolutely need deep technical knowledge of bankruptcy law. But just as important, you need the people skills to build relationships and the incredible, incredible patience to just wait, sometimes for years, for that perfect storm to finally hit. Which, of course, brings us to today. After years of really low interest rates and a pretty strong economy, what does the world look like through the eyes of a master distressed debt investor? Where are the opportunities hiding right now? Well, Karsh has this brilliant metaphor for it. Think of all the corporate debt that's been issued over the last decade. All the leveraged loans, the high-yield bonds. Think of all of it as logs being stacked for a bonfire. He says that right now, those logs are stacked incredibly high. The amount of fuel out there is massive. But, and this is the crucial part, there's no spark. The economy is still too strong. So the conditions for a huge, widespread crisis aren't here yet. But the potential for one heck of a bonfire is bigger than it's been in a long time. And that really leaves us with one last big thought to chew on. This entire strategy, from top to bottom, is built on confronting the one thing most of us spend our lives trying to avoid. So it raises this fascinating question that goes way beyond just finance. In a world that is absolutely terrified of failure, what is the true value, financially, strategically, maybe even personally, of being the one person who isn't afraid to face it head on and is actually prepared to find opportunity inside of it?
All right, today we're pulling back the curtain on the world of venture capital. You know, it's this place of billion-dollar bets, legendary founders, and companies that literally change the way we live. From the outside, it can seem kind of complicated, almost like a secret club. But what if you had one of the guys who basically built the modern internet to give you the playbook? Well, that's what we're doing. Let's get into it.
This right here, this is the key. You have to get this one sentence to understand anything else we're going to talk about. Forget everything you know about normal investing, getting your 8 or 10%, playing it safe. Venture capital is a hunt. It's a relentless search for that one company in 1,000, the aberration that doesn't just do well, it creates a whole new category. The wins have to be so mind-bogglingly huge that they pay for all the failures and then some. That's the one rule you can't break.
Okay, so if it's all about finding these massive outliers, these aberrations, how in the world do you actually do it? I mean, really, when you've just got a couple of people in a garage with an idea, how can you possibly tell if it's the next big thing or just nothing? How do you separate the genius from the crazy? That is the billion-dollar question, right? And we're going to find the answer by looking at how one of the masters of this game thinks.
Now, before we go any deeper, let's just get our terms straight. Venture capital isn't about funding an idea scribbled on a napkin. That's more in the angel investor territory, where someone might write a personal check. VCs, they usually come in a little later,
We're talking about companies that have a real product, maybe some early users. VCs are managing big pools of money, and they're not just writing a check, they're signing up for a long, tough journey to build a company that can stand on its own.
You know, what's really wild about this is just how new this whole thing is. I mean, back in the 50s and 60s, if you said you wanted to give a bunch of money to a risky startup, people would have thought you were nuts. But then the 90s tech boom hit, and everything changed. All of a sudden, the VCs behind guys like Bill Gates and Steve Jobs weren't just investors, they were kingmakers. And today, VC isn't some weird little corner of the financial world. It's one of the main engines of the entire global economy. It's shaping everything.
To really truly get this mindset, you need a good story. And there is no better story than one that Marc Andreessen was right at the center of, not as an investor, but as a young founder himself. It's about a legendary miss, a time a big firm passed on a deal, and it perfectly captures the insane risk and reward of this whole game.
Okay, so picture this. It's the early 90s. The internet is this weird thing that mostly academics use. And in walk two guys, a legendary tech founder named Jim Clark and this kid fresh out of college, Marc Andreessen. They have this new company, Netscape, that's going to help people, browse the World Wide Web. They have basically zero revenue, and they're asking for an investment at a valuation of over $100 million. To the investors in that room, this sounded absolutely, completely insane. So what did these super smart, experienced investors do? They passed. They said no. The valuation was just too high, too crazy for a company that didn't even have a business model yet. And this is so important. Spotting a real outlier is hard because at the beginning, it often looks like a terrible idea. It has to. If it was an obvious idea, everybody would be doing it. These investors, they just couldn't see the future that was sitting right in front of them.
And here's the punchline. Just a couple years later, that same company, Netscape, was bought by AOL for $4.2 billion. That single decision to say no didn't just cost them a nice profit, it cost them a generational fortune. And this gets right to the heart of VC. The fear of losing your money on one bad investment is nothing, absolutely nothing, compared to the terror of missing the one that changes the world. The cost of a no can be 1,000 times higher than the cost of a yes.
Which brings us back to our guide, Marc Andreessen. I mean, look at this resume. This guy isn't just some theorist. He's lived this from every single angle. He was the kid in the Midwest who tinkered his way into co-creating Mosaic, the first web browser people actually used. He was the founder of not one, but two multi-billion-dollar companies. And then he went to the other side of the table and co-founded Andreessen Horowitz, A16Z, which is now one of the most powerful VC firms in the world. He's seen it all, which is why his playbook is so valuable.
So after having lived through that Netscape experience, being the founder who almost got passed on, how did he design his own firm to make sure they wouldn't miss the next one? Let's go inside the deal and see how Andreessen Horowitz actually works.
So how do you get a firm like this to give you money? For any entrepreneur out there, this is pure gold from Andreessen. First, build something. Don't just show up with an idea. Show up with a product. A working prototype is your best calling card. Second, this is a people business. You can't just cold email these guys. You almost always need a warm introduction from someone they trust. And third, you have to realize this isn't just a transaction, it's a partnership. He calls it a marriage, and he's not kidding. It's a 10, maybe 20-year commitment. You have to be ready for that.
Okay, now this is where A16Z really changed the game. See, most VC firms make their decisions in a big committee meeting. All the partners get together, they debate, they vote. Andreessen Horowitz uses what they call a single trigger puller system. Basically, each of their general partners is a deep expert in some area. They have their own budget, and this is the important part, they can decide to make an investment all by themselves. No committee vote needed.
And when you put these two models side by side, you really see the genius of it. A traditional committee, it's designed to build consensus. But what's the problem with that? Well, the really big ideas, the aberrations we talked about, they don't have consensus. They're weird. They're controversial. A committee can easily talk itself out of funding the next Airbnb. But the single trigger puller system, it's specifically designed to protect those weird ideas. It lets one expert who has deep conviction say, you know what, I don't care if you all think this is crazy, I'm making this bet.
So this system is built to adapt and find those outliers, which is absolutely crucial because the world these VCs are investing in is always changing. And the pandemic, well, it was like a massive earthquake that just completely reshaped the entire tech industry.
For decades, the rule was simple. If you were serious about building a tech company, you moved to Silicon Valley, period. That's where the talent was, that's where the money was, but that's just not true anymore.
Andreessen's big take is that Silicon Valley is moving to the cloud. With remote work, you can now hire the best engineer whether they're in Ohio or India. Just look at Coinbase, one of A16Z's biggest wins. They went public without having a headquarters at all. The whole map has been redrawn.
So in this new, spread-out world, where are guys like Andreessen putting their chips? What are the huge technological shifts that they think are going to define the next decade? This is where we get a peek into the future.
Now listen, forget the daily price of Bitcoin for a minute. When Andreessen talks about crypto, he's not talking about it like a stock you trade. He sees the technology underneath it all as one of the handful of massive foundational shifts in the history of computers. As big as the microprocessor, as big as the internet itself. It's a whole new kind of computer, a new platform.
So, what is this huge breakthrough? It's a computer science idea called distributed consensus. Okay, that sounds complicated, but here's a simple way to think about it. It's a way to get a huge network of computers all over the world, none of whom trust each other, to all agree on a single source of truth. And that lets you do things like build a financial system that doesn't need a central bank or a government to run it. It's like a financial system that's native to the internet. And that is a really big deal.
The other massive frontier he's betting on is this merger of biology and computer science. For most of history, biology has been a slow, messy, trial-and-error process. But now you've got this new generation of founders who are experts in biology and in software, AI, and engineering. They're starting to treat biology like an engineering problem. And the most incredible example of this? Moderna. The reason they developed a COVID vaccine in just 2 days is because their mRNA platform isn't like old-school medicine. It's like programming a vaccine with computer code. That is a total game changer.
Okay, so we've been through the history, the tactics, the future bets. After all of that, what's the one thing you really need to take away from this? What's the core philosophy that drives someone who's a master at this game?
I really want you to think about this. In a business where you fully expect half of your investments to go to zero, to completely fail, what could possibly be the biggest mistake? It's not what you think it is.
And there it is. That's the whole ball game. In venture capital, your costliest mistakes are not the companies you invest in that fail. Those are just the cost of doing business. The catastrophic mistakes, the ones that haunt you, are the future Googles and Facebooks and Netscapes that you looked at, you had a chance to invest in, and you said no. The sin of omission is infinitely worse than the sin of commission.
So how do you avoid that huge sin of omission? What does it actually take to be good at this? Well, as you can see, it's not just one thing. Andreessen calls it an alchemy, a liberal art. And these three things are all equally critical. You have to have a deep, deep understanding of technology. You have to understand markets and how they're going to evolve. But just as important, you have to understand people, the drive, the resilience, the pure will of the founders you're going to be married to for the next 10 or 20 years. Success is where all three of those things meet.
At the end of the day, it all comes back to where we started. Venture capital is the business of funding the future. It's a nonstop search for those rare, beautiful aberrations that break all the rules and completely reshape the world we live in. The firms that win are the ones built from the ground up to find and back those ideas, no matter how crazy they might seem at first. Which really just leaves one big question. What's the next one?
All right, so when you think of a Silicon Valley kingmaker, what comes to mind? Probably a Stanford-educated engineer, right? Someone who did a tour of duty as an exec at some huge tech company. But what if I told you that one of the most successful venture capitalists of all time was none of those things? Today, we're going to dive into the playbook of Michael Moritz, the guy who helped make Sequoia Capital what it is today by basically tearing up the rulebook on who gets to win in VC.
And this quote, man, this just says it all, doesn't it? This is the key to his entire mindset, and you really have to get this to understand the rest. For him, this whole business isn't just about spotting the next hot trend. No, it's about backing the crazy ideas, the ones that most people would just dismiss out of hand. It's about making the impossible, well, possible. And in a lot of ways, that's kind of the story of his own career.
Okay, so just look at this comparison. It's wild. It lays out the whole paradox of Michael Moritz so clearly. On the left, you've got your standard issue VC, right? The Stanford degree, the engineering background, the stint at Intel. And then on the right, you have Moritz, a Welsh immigrant, a history major from Oxford, and he started out as a journalist, what he called an ink-stained wretch. So the big question is, how on earth did this complete outsider end up dominating the ultimate insider's game? To figure that out, we're going to break his playbook down into 5 parts. First, we'll look at how this total long shot even got his start. Then, we'll see how that journalism background of his became a kind of secret weapon.
We'll get into Sequoia's core investing philosophy, see how he took that model global, and then finally, we'll uncover the one single trait that he values above absolutely everything else.
All right, let's get into it. Part 1, the unlikely venture capitalist. This is the origin story, right? It's how a writer from Wales somehow managed to break into what might just be the most exclusive club in the world.
You gotta understand, there was nothing on his resume that screamed venture capital. I mean, nothing. He's the son of refugees who grew up in Wales, and his passion was writing, not making deals. He comes over to the US, gets a job at Time magazine, and starts covering the very beginning of the PC revolution. And he got so deep in that world that he wrote a book called The Little Kingdom, which, by the way, is still considered one of the absolute best books ever written about the early days of Apple. Which, of course, brings us to the million-dollar question. How does a guy like that even get his foot in the door in this super exclusive world? He wasn't just an unusual choice. By the standards of the 80s, he was an impossible choice. And get this, when he decided he wanted to make the jump, he applied to 5 VC firms. 4 of them turned him down flat, probably didn't even know what to make of him.
But that 5th firm, that was Sequoia. And its legendary founder, Don Valentine, saw something everyone else completely missed. Valentine had this idea that the VC industry was getting too predictable, too straitjacketed in its thinking. He was tired of seeing the same old resumes. He knew that just because someone had the perfect credentials didn't mean they'd be a good investor. He'd seen plenty of those guys fail spectacularly. In Moritz, he saw a different kind of smarts, an ability to find a story and tell it. And he took a chance, a really big one, on the outsider.
Okay, on to part 2. And this is where it gets really interesting. We're going to see how what everyone thought was his biggest weakness, that journalism background, actually turned out to be his investing superpower.
You know, Moritz himself laid it out. He said his process for evaluating a deal was almost exactly the same as being a journalist, and it makes perfect sense when you think about it. First, you have to actually listen, really hear what people are telling you. Second, you have to get comfortable with the messiness of it all, the murkiness and obscurity, as he put it. That's what early-stage investing is. It's finding a signal in all the noise. And then, and this is the key, you have to boil everything down to its core, find the real story, and then be able to tell that story clearly. That's how you get your partners on board, and it's how you get founders to trust you.
So that leads us right into part 3, the Sequoia investment tripod. This is the absolute core of their philosophy. And this simple idea, championed by Moritz, is behind some of the biggest home runs in investing history. We're talking Google, PayPal, WhatsApp, Stripe. The list just goes on and on. And it's so simple, it's almost deceptive. Moritz calls it a happy balance between 3 things, kind of like a 3-legged stool. First, you've got the founders, the people. Who are they? What's their character? Then, you've got the market. How big can this thing actually get? And finally, you've got the product itself. Is it really different? Is it truly better? The secret sauce isn't in finding one perfect leg. It's about making sure all 3 are strong and in balance. This became the lens they used to look at every single deal.
Now, speaking of those legendary deals, there's this one story about Google that everyone loves to tell. The myth is that about a year in, Sequoia got so fed up with Larry and Sergey that they actually threatened to pull their money. So, did that really happen?
Well, the short answer is no. It's mostly a myth. Moritz has been pretty clear that the story got blown way out of proportion. It makes for a great Silicon Valley legend, for sure, but what really happened is actually a lot smarter and way more interesting.
Okay, so here's the real story. 15 months in, Google had burned through a ton of cash. And remember, this wasn't the Google we use today. Their plan was to license their search technology to other companies. So the pressure from investors wasn't a real threat. Moritz called it a way of heightening the sense of urgency. They needed to get real professional management in there to help these 2 brilliant but very young founders. It was a strategic nudge to protect their investment, not a threat to kill it.
And that kind of move is all about playing the long game. Moritz boils that whole long-term vision down to this incredibly simple but powerful little shorthand, 20/20. And the question they ask themselves is this: can this company compound at more than 20% a year for 20 years? Just think about that for a second. That's the bar. In a world that's obsessed with quick flips, that philosophy forces a completely different kind of discipline and patience.
All right, that takes us to part 4, building a global dynasty. See, for Moritz, just winning in Silicon Valley was never going to be enough. He was the architect behind Sequoia's global expansion, and he did it in a way that nobody else had even dared to try.
So, let's look at how most VC firms tried to go global back then. It was all centralized. All the big decisions were made by a committee back at headquarters in California. They were basically just franchising their brand name.
Sequoia, with Moritz leading the charge, did the complete opposite, especially when they went into China. They found the absolute best local leaders and gave them total autonomy. Decisions were made right there on the front lines by the people who actually understood the market. It was a true partnership, not some colonial outpost.
And Moritz had this brilliant analogy for it. He compared the old, centralized model to World War I generals, trying to run a battle from a comfortable dining room 30 miles away from the action. He said it flat out. It doesn't work. You have to trust the people on the ground. People like Neil Shen, who they backed to build Sequoia China into an absolute powerhouse. And man, that's a profound lesson in humility, isn't it? It's admitting that you have to know what you don't know.
Okay, this brings us to the final piece of the puzzle, the big one. We're going to distill this entire incredible playbook down to the one single, non-negotiable trait that defines not just a Sequoia investment, but a Sequoia partner too.
So after all this, what is it they're really looking for? Is it having been an entrepreneur before? Having deep operating experience? A quirky mindset? That Stanford MBA? Well, Moritz says sure, it can be all of the above. They hire people from all kinds of backgrounds. But none of those, not one, is the deciding factor.
The single most important trait is just one word: hunger. A relentless, insatiable drive to win, to build, to do the thing that seems impossible. It's not about your resume. It's about what's in your gut. It's the one thing you absolutely cannot teach, and it's the one thing you can't succeed without.
And this quote just drives the point home perfectly. For them, making a ton of money isn't the finish line. In fact, if you get comfortable, you're out. He says, look, if somebody makes a lot of money and wants to punch out, that's totally fine. But they can't stay at Sequoia. They only want the hungry. And it doesn't matter if you're 25 or 65. It's a culture of perpetual, restless ambition.
So, to wrap this all up, what do you think is the biggest frustration for a man who has achieved this much success? You'd think it would be a deal he missed, or an investment that went sideways, right? Nope, it's actually something much more fundamental to his whole way of thinking.
His biggest frustration is that people just don't get that Sequoia is playing an entirely different game, that they are, in his words, the longest-term investor on the face of the earth. The entire playbook we've just gone through, hiring the journalists, the investment tripod, empowering local teams, the relentless search for hunger, it's all designed for one single purpose: to find and nurture companies for decades. It's about having the conviction to prove over and over and over again that the impossible is, in fact, possible.
All right, let's talk about cryptocurrency. I mean, you can't escape it. Is this the actual future of money, or is it just a massive digital house of cards waiting to collapse? It has made people billionaires overnight, and it has fueled some of the fiercest debates I've ever seen. To really get to the bottom of it, we're going to do something a little different. We're not going to listen to some tech utopian from Silicon Valley. No, we're going to listen to a guy who is a titan of old-school Wall Street before he went all in on this new digital frontier. It's time to decode this thing. In that guide, that Wall Street titan is Mike Novogratz. Now, this isn't some kid in a hoodie. This guy was a partner at Goldman Sachs. He's now the CEO of a huge crypto investment firm called Galaxy Digital. And for him, as you can see from this quote, this isn't just about a new coin or a new way to pay for stuff. He sees something much, much bigger happening, a fundamental collision between our digital lives and our physical world. Okay, so here's our game plan. We're going to start with how this whole crypto revolution even began. Then, we'll get to know our guide, Mike Novogratz, a little better. After that, we'll dive right into the heart of the great crypto debate. We'll explore the vision for a totally new financial system. And finally, we'll get some practical advice on how a seasoned pro actually thinks about investing in this wild space. So first up, the crypto revolution. You know, you got to remember, this stuff didn't just appear out of thin air. The original crypto, Bitcoin, it was literally born from the ashes of the 2008 financial crisis. It was a direct reaction to people completely losing faith in the big banks and the governments that are supposed to be managing our money. And man, from that one fringe idea, it just exploded. I mean, look at this number. We're talking about a market that, at its peak, was worth multiple trillions of dollars. That is bigger than the entire economy of most countries on Earth. It became an absolute financial behemoth. But of course, with that kind of insane growth, you get a ton of pushback. And you've heard all the arguments, right? That it's got no real value, it's basically a modern-day tulip bubble, that it's just a playground for criminals, that it's an environmental disaster, and that it's a real threat to our stable, government-backed money. We're going to tackle all of these head-on.
And that brings us right back to our guide for navigating this whole minefield. See, if you really want to understand the pro-crypto argument from someone who knows how the real financial world works, there's nobody better than Mike Novogratz. He's not some starry-eyed idealist. He is a product of the very system that crypto wants to disrupt.
I mean, just look at this resume. This is pure Wall Street royalty. A partner at Goldman Sachs, president of Fortress Investment Group. This is a guy who lived and breathed traditional finance for decades. And then he saw something that completely changed the entire course of his career.
And here it is. This quote pretty much pinpoints the exact moment the light bulb went on for him. He realized it wasn't just about a new type of currency. The real breakthrough, the thing that changed everything, was the technology underneath it all, the blockchain. For the very first time in history, you could create something digital that you couldn't just copy and paste. You could have true digital scarcity. That was the game changer.
Okay, so let's get into it. The great crypto debate. We've laid out the biggest criticisms. Now let's see how a major player like Novogratz pushes back. But to do that, we first have to get a handle on that core technology I just mentioned. At the very heart of all of this is the blockchain. Now, the easiest way to think about it is like a shared digital record book or a public ledger. Every single transaction is a block of information. And once that block is full, it gets permanently linked to the one before it, creating this unbreakable chain. And because this whole ledger is copied and spread out across thousands of computers all over the world, it is incredibly, and I mean incredibly, difficult for anyone to cheat or tamper with it. It's a system built on transparency, not on trust in a single company or bank. And this table here really just lays out the fundamental difference. On one side, you have your regular government money, right? It's backed by trust in that government, and it's controlled by big central banks. Its value exists because they say it does. On the other side, you've got crypto. It's totally decentralized. No one's in charge. It's run by a network on the blockchain, and its value comes from a combination of its built-in scarcity and the number of people who believe in and use that network. It is a completely different way of thinking about value. Okay, let's tackle the first big one, the elephant in the room, the environmental cost. You've definitely heard this one, that mining for coins like Bitcoin uses a horrifying amount of electricity, enough to power a small country. So what's the comeback to that?
Well, Novogratz's response is punchy. And honestly, it's pretty surprising. Christmas lights. His whole point here is that while yes, Bitcoin definitely consumes energy, the scale of that consumption has been blown way, way out of proportion in the public debate.
And if you look at the numbers, they kind of back him up. Bitcoin mining accounts for just over 0.5% of all the electricity used in the world. Now, that is still a lot of energy, no question, but put it in context. It's actually less than what we use for holiday lights every year, and it's 7 times less than the energy it takes to power YouTube. So his point isn't that it's green, but that we need to have a little perspective.
All right, on to the next major criticism. The whole idea that crypto is basically the currency of choice for criminals. That it's used for everything from money laundering to ransomware attacks.
Novogratz is pretty blunt about this. He just calls it a non-story. Now, his argument is that, yeah, of course some crime happens using crypto, just like criminals use cash, but it's a tiny, tiny fraction of all the activity. And here's the kicker. Because the blockchain is a public, unchangeable record, these transactions can often be traced. It's actually a pretty terrible tool if you're a criminal looking for real, long-term anonymity.
So what about that tulip mania argument? The idea that crypto has no substance, no real value. Novogratz says you have to split the crypto world in two. First, you have Bitcoin. He thinks of Bitcoin as a store of value, like digital gold. Then you have everything else, like Ethereum. And he sees Ethereum as something completely different. It's like the foundational software for a whole new decentralized internet. It's a platform where developers can build all sorts of new things, from new financial tools to NFTs.
And this might be his most powerful point of all. He argues that the real raw energy behind crypto isn't just about the tech. It's generational. It is a movement being driven by a younger generation that's grown up watching financial crises, rising debt, and feeling like the traditional financial system is rigged against them. They're looking at this old, creaky system and saying, you know what? We can build something better.
So, if this is a movement to build something better, what does that new system actually look like? This is where the vision gets so much bigger than just buying and selling coins. We're talking about revolutionary ideas like decentralized finance, or DeFi, and the metaverse.
DeFi is short for decentralized finance, and the core idea is pretty simple actually. Rebuild all the traditional financial services, getting a loan, earning interest, exchanging currencies, but do it without the middlemen, without the banks. Instead of relying on a bank's rules, the rules of the transaction are just written into computer code on the blockchain. The goal is to create a system that's more open, more transparent, and more efficient for everyone. Now, the magic ingredient that makes all this possible is a concept called composability. It's a fancy word, but think of it like digital Legos. Someone builds a foundational platform like Ethereum, that's your big green baseplate, then other developers can come along and just snap new innovations like NFTs right on top of it. And then someone else can build on top of that. This ability to easily build on top of what others have already made just creates this explosion of innovation. Okay, so this all sounds incredibly exciting, maybe a little mind-bending and revolutionary, but let's bring it back down to earth. What does this mean for an average person? How should you approach this from an investment standpoint? Let's get some practical advice from a guy who's been trading his whole life. Novogratz' advice here is crystal clear, and it's all about caution. You have to treat crypto as a very high-risk asset. He suggests you should allocate no more than 5% of your total portfolio to it. 5%, that's it. And even inside that tiny little slice, he says you should spread your bets. A third in Bitcoin, as that digital gold, a third in Ethereum for its massive tech potential, and a third in other crypto-related assets. The key takeaway is simple. This is a speculative bet. This is not a safe place to park your retirement savings. And so that leaves us right here with a big trillion-dollar question. Are we standing on the ground floor of a genuine technological and financial revolution that will change everything? Or is this whole thing just a massive speculative mania, a bubble fueled by hype and easy money that's destined to come crashing back down to earth? Right now, the jury is very much still out, and honestly, that's what makes this whole space so fascinating to watch. Welcome to The Explainer. Today, we're talking about a financial tool that didn't just make a splash on Wall Street, it created a tidal wave. It completely changed the game for how companies go public, and we're talking about the SPAC. All right, here's what we've got on tap. First, we're going to look at the old, painful way of doing things, the traditional IPO. Then we'll dive into what a SPAC is and how its life cycle actually works. We'll look at the different kinds of money that fuel these deals, talk about that insane boom, and what happened after. And we'll wrap it all up with some killer insights from a true master of the SPAC universe. Okay, let's get into it. You see, to really get why SPACs became such a phenomenon, you first have to understand the headache they were designed to cure. And that headache is the traditional initial public offering, the IPO. For decades, if you ran a successful private company and wanted to raise a boatload of cash by selling stock to the public, there was really only one way to do it, the IPO. It's the classic path. But classic doesn't mean it's pleasant. A traditional IPO is just an absolute marathon. We're talking at least 6 months, usually longer. The cost? Through the roof. You're buried in paperwork for the SEC, you're paying millions to investment banks, and then you have to go on this grueling roadshow to pitch your company over and over. This whole process is so slow and so expensive that it basically created a huge opportunity for a smarter way. And that smarter way, that solution, is the Special Purpose Acquisition Company. You probably know it by its much cooler nickname, the SPAC. So what in the world is a SPAC? Well, at its core, it's a brilliantly simple idea. It's a shell company. It doesn't make anything. It doesn't sell anything. It's basically a publicly traded pot of cash. And its one and only job is to go out, find a real private company, and buy it. By doing that, it takes the private company public. It's as simple as that. As one of the pioneers of the SPAC world, Betsy Cohen, puts it, it's really just a reverse merger. You see, instead of a private company going through all that IPO pain, a public company, the SPAC, comes along and swallows it whole. It's like finding a shortcut, a backdoor to the stock market. Now, here's the part that really matters. When people first put money into a SPAC, they have no idea what company they'll end up owning. They're literally giving a blank check to the SPAC's management team, who are called sponsors. You're not betting on a company. You're betting on the person. You're trusting that they're a genius who's going to find the next big thing. So, how does this blank check actually morph into a real, living, breathing company that you can buy and sell on the stock exchange? Well, it all happens in a pretty clear set of stages. The whole thing unfolds in 5 steps. First, a sponsor, usually a big-name investor, forms the shell company. Second, that shell company has its own IPO to raise all that cash. Third, with money in the bank, the sponsor starts hunting for a target. Fourth, once they find one, they bring the deal to the shareholders for a vote. And fifth, if everyone says yes, they merge, and just like that, you've got a new public company. But there's a catch, right? The sponsors are on the clock. They've got a deadline, typically somewhere between 18 and 24 months, to find a company and seal the deal. If they can't do it in time, the SPAC is liquidated and everybody gets their money back. So the pressure is on.
Now, a lot of the time, the money the SPAC raised in its IPO isn't quite enough to buy the awesome company they found. So to get the deal done, they need to bring in another group of investors to top off the tank.
And this is where something called a PIPE comes in. It stands for Private Investment in Public Equity. The sponsor basically goes to huge investors, like hedge funds, and says, hey, we found a winner, we've got a deal on the table, but we need a little more capital to make it happen. And that extra money is the PIPE. And this table really shows you the difference between the two groups. The initial SPAC investor, they're taking a leap of faith. They're betting on the jockey without even seeing the horse. For taking that risk, they get rewarded with warrants, which are like bonus lottery tickets to buy more stock cheap later on. The PIPE investor comes in much later. They know exactly what company they're investing in, so it's way less risky, but they don't get those juicy warrants. So you have this really elegant structure, the SPAC plus the PIPE. It's a flexible, powerful machine for taking companies public. And around 2020, that machine went into overdrive, and the market just went bananas. I mean, look at these numbers. It's just staggering. In 2020, SPACs made up more than half, 53%, of all the companies going public in the US. And the next year, it got even crazier, climbing to 59%. It wasn't just a trend, it was a revolution.
But, well, the party didn't last forever. As our source material says, the bloom came off the rose. A ton of deals flooded the market, and frankly, a lot of them weren't great. The result? A whole lot of pain. The reality is, most of the companies that went public with a SPAC are now trading for less than the $10 a share they started at.
So, was it all just a fad? Is the SPAC dead? Well, Betsy Cohen says no. She makes a great point here. The SPAC market is just like the IPO market. It runs in cycles. It's a tool, and there are good times to use it and bad times. Its popularity will ebb and flow with a wider economy. But even when the market got tough and a lot of people were losing money, some sponsors kept hitting home runs. And that brings us right to the expert we've been leaning on, the woman they call the Queen of SPACs, Betsy Cohen. Her resume is just wow. She's founded 8 public companies and led a dozen successful SPACs. But she's been breaking barriers her whole career. Get this. Way back in 1973, she became the first woman in Pennsylvania to even apply for a bank charter. That tells you she's been a force to be reckoned with for a long, long time. So what's her secret? Specialization. She sticks to what she knows, which is financial services. And as the SPAC market cooled off, it became painfully obvious that the single most important factor for success was the quality of the sponsor. You had to trust that the person holding your blank check was an expert who could do the hard work and pick a real winner. Okay, so this brings us all the way back to the most fundamental question of all. If you're a really great private company, why go the SPAC route at all? Why not just stick with the old-fashioned IPO? And this, right here, is the answer. This is the core advantage. In a traditional IPO, you're selling your history. You show investors your past revenues, your past profits. But a SPAC lets you sell your future. It lets you talk about your vision, your projections, what you are going to become. For an innovative company on the brink of something huge, that is an absolute game changer. In the end, the story of the SPAC isn't just about a clever piece of financial engineering. It's about a new way to fund innovation. It's a structure that rewards a belief in the future. And as Betsy Cohen says so well, whether you're building a business or making an investment, that kind of success always starts with thinking about things differently.
You know, when you're driving over a bridge or catching a flight at the airport, turning on the tap for a glass of water, do you ever stop and think, who actually owns this thing? For a long, long time, especially here in the US, the answer was pretty simple. The government, right? But what you might not realize is that there's been this quiet trillion-dollar revolution happening right under our feet, and it's changing everything. It's reshaping the very foundations of our world.
And right at the heart of that revolution is this one really provocative idea. It comes from Adebayo Ogunlesi. He's the founder of the world's biggest independent infrastructure investment firm. And his whole bet, the entire thesis, is simple. He says, we think we can do a better job of running these assets than the government can. Now that is a bold claim. And throughout this explainer, that's exactly what we're going to dig into. We're going to put that claim to the test.
All right, so here's how we're going to break it all down. First, we'll talk about this invisible revolution. Then, how infrastructure even became an asset class in the first place. We'll look at a really cool case study, the Gatwick playbook. Then we'll dive into why investors love this stuff, get to know the man behind it all, and finally, ask what this means for our future. Let's get into it.
Okay, Section 1, the invisible revolution. So who really owns our bridges, our airports, our roads? You know, we tend to think of all these huge, important things as public, right? But the reality is, those lines of ownership are getting really, really blurry in ways that most of us just never see.
All right, so moving into Section 2, a new asset class. This whole shift, it didn't just happen overnight. It took a massive change in how people think about these things, turning infrastructure into, well, an asset class, something you can buy and sell. I mean, for most of the 20th century, building and running these giant projects was the government's job, period. The private sector, they weren't really interested. So what on earth changed?
Well, you can trace the seeds of this back to the 1980s. Over in the UK, you had Margaret Thatcher, who was all about smaller government, and she started selling off state-owned companies. Think British Telecom, BP, even airports. Then Australia jumped on board, privatizing all of its airports. They figured the private sector could just run them better. But the real game changer, that came in the early 2000s. That's when firms showed the world just how much money could be made. And once that happened, the floodgates opened. Global capital started pouring in.
And just to give you a sense of the scale here, let's set a baseline. Go back to the year 2000. The total amount of money invested in private, unlisted infrastructure globally, just $7 billion. I mean, that's it. It was a tiny little corner of the financial world, almost like an experiment.
Okay, fast forward to today. That's $7 billion. It's now nearly $1 trillion. That's not just growth. That is an explosion. We're talking about the birth of an entirely new, massive force in the global economy. And it's fundamentally changing who builds, who owns, and who controls the absolute bedrock of our society.
So when we say infrastructure investing, what are we actually talking about? Well, the definition is pretty simple, but it's incredibly powerful. It's about owning and operating the stuff that a modern economy needs to function. We're not talking about optional luxuries here. We're talking about the things you and I can't live without. Airports, toll roads, ports, the energy grid, the absolute core of everything.
So let's get into Section 3, the Gatwick playbook. Because look, it's one thing to talk about this in theory, right? The big claim is that private investors can run these things better. So let's see it in action. We're going to look at a classic case study, a real masterclass in how this is done.
Okay, so here's the puzzle. Adebayo Ogunlesi's firm, GIP, buys London's Gatwick Airport. Now, Gatwick is the world's busiest single-runway airport. It was already stretched to what everybody thought was its absolute limit. The question was, how in the world do you make it better? How do you squeeze even a drop more efficiency out of it?
Well, the results were pretty incredible. Just look at these numbers. They managed to increase the number of takeoffs and landings per hour from 50 to 58. That's a huge deal. But the real jaw-dropper? Security. They took the number of passengers they could get through a security line each hour from 150 to 600. They quadrupled it. I mean, that is just a staggering improvement.
So you're probably asking, how did they do that? Did they spend billions on a new terminal? Nope, it was all about smart, focused problem solving. For the runway, they used data analytics to figure out the absolute most efficient way to sequence planes. And for security, get this just shows you the level of detail they went into. They realized one of the biggest bottlenecks was the size of the plastic trays we all use. They were too small, so they just made them bigger. A simple fix that had this massive, massive impact on the whole process.
And this is where it all comes together. As Ogunlesi himself puts it, it's good for passengers, it's good for the airlines, and of course, that's good for us. It's good for everybody. See, it creates this virtuous cycle. Happier passengers who aren't stuck in line have more time to spend money, airlines can run their schedules more efficiently, and of course, the airport owners make more money. It's pitched as a win for everyone involved.
Okay, Section 4, why investors love infrastructure. So we've seen how they can improve operations. That's the how. But now let's talk about the why.
Why are the biggest investors on the planet falling all over themselves to get into a business that, let's be honest, used to be kind of boring?
Well, it really comes down to three key things. First, you get these really predictable cash yields. These assets are like cash machines, delivering steady returns. We're talking 10 to 12% a year for a firm like GIP. Second, they're stable. An airport doesn't care if the stock market is having a bad day. It provides diversification. And third, and this is a big one, they're protected against inflation. Think about it. Toll road prices, airport fees, they're often tied to inflation, so your investment is naturally hedged.
And you might be wondering, who is putting up all this cash? We're talking almost $1 trillion here. Well, it's not just a handful of super rich guys. The lion's share of this money comes from two main places. Pension funds, so that's the retirement money for teachers, firefighters, millions of regular people, and sovereign wealth funds, which are these huge pools of money that entire countries invest. So in a very real way, the world's collective savings are being funneled into this asset class.
All right, Section 5, the man from Ibadan. You really can't tell the story of this financial revolution without talking about the person at the center of it. To really get what's happening, you have to understand the incredible journey of Adebayo Ogunlesi.
I mean, his resume is just something else. He grew up in a university town in Nigeria. From there, he goes to Oxford. Then he gets both a law degree and an MBA from Harvard at the same time. His first job out of school, clerking for Supreme Court Justice Thurgood Marshall, which he called the best job I've ever had. After that, he spends 23 years at Credit Suisse, climbing all the way to the top, running the whole investment bank. And then, in 2006, he leaves all that behind to co-found Global Infrastructure Partners, or GIP.
And he got this piece of advice from the legendary investor Henry Kravis that really explains the huge mental shift he had to make. Kravis told him, no matter how smart you think you are, there really is no substitute for experience in the investment business. You see, as a banker, you're an advisor. Your job is to make deals happen. But when you become an owner, an investor, everything changes. Suddenly, you have to live with the consequences of your decisions, so you become obsessed with what could go wrong.
Which brings us to our final section, building tomorrow's world. We've seen this massive shift of capital, of talent, into the private sector to manage our public spaces. So what does that actually mean for the future, for the world that we're all going to be living in?
Well, let's start with this. It's a single-letter grade, but it tells you so much. Every few years, the American Society of Civil Engineers gives U.S. infrastructure a report card grade. The most recent one? A C-. C-. I love what Ogunlesi says about this. He says if your kid brought home a report card with a C-, you take away their iPad.
And this really gets to the heart of the issue. The old way of doing things, where the government paid for everything, it's just broken. Governments are juggling huge priorities, right? Defense, healthcare, education. And that's left a funding gap for infrastructure that's measured in the trillions of dollars. And that's the core dilemma. You have this massive need, and at the same time, this vast ocean of private money that's just waiting, wanting to be invested.
This quote from Ogunlesi just nails it. He says, if you fly from Dubai or Singapore to New York, judging just by the quality of the airports, you think that the U.S. was the developing country. And if you've done any international travel, you know exactly what he's talking about. That feeling is so real. The difference between these shiny, modern airports and other parts of the world and what you often find here, it's stark, and it really underlines how urgent this problem is.
And so it leaves us with this huge, critical question, doesn't it? With governments struggling to keep up, is private ownership of our essential services our only path forward? I mean, the argument for it is powerful. You get expertise, you get efficiency, and you get access to trillions of dollars in capital that governments just don't have. But these are our most essential services we're talking about. Our airports, our power grids, our water. As we hand over the keys, we have to really think about the trade-offs. What happens when the things we all depend on to live are driven by a profit motive? Is this the best way forward? And if it is, what are the rules of the road? That's the question for all of us.
Welcome to The Explainer. Today, we're going to jump right in and talk about 3 little letters that are causing a huge stir in the financial world. E, S, and G. And really, it all boils down to this one massive question. Can you actually grow your money and make the world a better place at the same time? Can you do good and still do well?
Okay, let's start with this quote from investor David Blood, because it's a real game changer. He says if you don't consider ESG, you're not fulfilling your fiduciary duty. Now, fiduciary duty, that's a really important term. It's the legal and ethical obligation to act in someone's best financial interest. And forever, that meant one thing and one thing only:
get the highest profit. So this idea that ignoring things like the environment is a failure of that duty? Wow, that is a huge, huge shift. So how on earth did we get here?
And to really get why that quote is just so revolutionary, we've got to rewind the clock a bit. Let's take a look at the old rulebook for investing. You know, it was a simpler time, and you could say a much colder world.
For decades, for the longest time, the game was just brutally simple. Make as much money as possible. Full stop. All that other stuff, pollution, how you treat your employees, what the board of directors looks like, that was all just externalities. Basically someone else's problem, not part of the core financial calculation at all.
But then things started to change. Over the past few decades, this new idea, this new framework, started bubbling up from the fringes to challenge that old way of thinking. And it's all built around these three simple but, man, incredibly powerful letters: E, S, and G.
So what are we actually talking about here? When an investor looks at a company through this ESG lens, what are they seeing? Well, you can think of it like a new set of tools in the toolbox. It's a way to measure not just the bottom line, the financial health, but also its long-term sustainability, its ethical backbone.
Let's break it down real quick. The E is for environmental. Pretty straightforward, right? What's the company's impact on the planet? Is it contributing to climate change, or is it working towards net zero? Then you've got S for social. This is all about relationships. How does it treat its people, its customers, its community? Does it promote equity, diversity? And finally, G for governance. This is all about how the company is run. Who's in charge? Are they looking out for shareholders or just themselves? So you see, it's a way to get the whole picture of a company's long-term health.
All right, let's get into the real meat of it. Because the second this ESG idea showed up, it ran smack into the old way of thinking. And that created this huge central conflict. It raised this big, flashing red light of a question that everybody, and I mean everybody, started asking. And here it is. This was the billion-dollar question. Heck, the trillion-dollar question that basically kept this whole idea on the bench for years. The thinking was simple. If you start saying no to certain companies because of your principles, you're shrinking your universe of choices. And if you do that, well, you're just going to make less money. It was almost a given.
But this is where things get really interesting. You've got these two totally different ways of looking at it. The old school belief, it's a penalty. You're just cutting out entire industries, think oil, tobacco, whatever. You're limiting your opportunities, so of course your returns are going to be lower. But then this new evidence, this new way of thinking comes along, and it says, whoa, wait a minute. ESG isn't about exclusion. It's a tool for insight. It helps you see things about a company's quality, its management, its hidden risks, things you'd otherwise miss. And that, they argued, actually leads to better returns.
And that brings us to a firm that basically said, okay, enough talk. Let's put this theory to the ultimate test. They decided to bet the farm, their reputations, a ton of money, on the idea that ESG wasn't a handicap, but a secret weapon.
So, back in 2004, you get this incredible team-up. David Blood, a former top guy at Goldman Sachs, joins forces with former U.S. Vice President Al Gore, and they create Generation Investment Management. The nickname they got in the press? Blood and Gore. Come on, you can't make this stuff up. But behind that clever name was a really radical, industry-shaking idea. And this quote from David Blood really lays out their entire thesis. He said their whole bet was on long-term investing, with sustainability as a key economic driver, and using ESG as a tool, not to feel good, but to understand the quality of a business and its management. See, they weren't just trying to be the good guys. They were making a cold, hard financial argument. This is just a smarter way to invest.
So, the big question is, did it work? Did the Blood and Gore bet pay off? Well, this number right here pretty much tells the whole story. 500. That's 500 basis points. That's how much their main fund has beaten its market index since they started. Staggering.
Now, just to put that into perspective for you, 500 basis points is 5 full percentage points. In the world of big-time fund management, that's not just a little bit better. That is a massive difference. It's the kind of performance that makes everyone on Wall Street stop and pay attention.
So what does this all mean? The key takeaway here is that this wasn't a fluke. This was the proof of concept the industry needed. Their success was powerful, real-world evidence that ESG could actually drive better financial results. And why? Well, think about it. A company that really cares about this stuff is probably better managed, better at seeing risks down the road, and more attractive to top talent.
Those aren't fluffy things. Those are signs of a high-quality business. It proved that this wasn't about trading value for values. It was just a better, more thorough way to invest. Period.
And you know what? Generation's success wasn't just some one-off story. It was more like the first big earthquake. The tremor that signaled a massive, tectonic shift was happening underneath the entire investment world.
I mean, look at this journey. You go from the early 2000s, where this was a fringe idea, something you did if you were okay with making less money. Then 2004, you have the big test case with Generation. And now, today, it's becoming part of that fiduciary duty we talked about at the beginning. It's gone from something you shouldn't do to something you have to do. What a journey.
Okay, so great news, right? ESG is mainstream. But with that popularity comes a whole new can of worms, because now everybody wants to say they're an ESG investor. Every fund wants to slap an ESG-friendly label on the box. So the new problem is, how do you know who's for real and who's just faking it?
And that brings us to this huge problem we're facing right now: greenwashing. You've probably heard the term. It's basically when a company or a fund talks a big game about being sustainable, but it's all just marketing smoke and mirrors. There's no real action behind the pretty label. It's a massive issue, and it's making it really hard for investors to know what's what.
So to fight back against all this greenwashing, the industry is basically in a mad scramble to create some rules for the road. There's this huge push for standards. We're talking about new initiatives for disclosure, a brand new International Sustainability Standards Board. The whole goal is to bring some transparency to all this. You want to create a common language, so an ESG claim in one place means the same thing somewhere else. It's like trying to tame the Wild West of sustainable investing.
All right, so here we are. ESG has gone from this radical idea to a standard part of the toolkit. So what's next? Where does this all go from here?
And I think this last quote from David Blood really brings us back down to earth. He says there's this feeling out there that sustainable investing is always a win-win, but it's not. It's not that simple. There are often real trade-offs you have to make, and that's the challenge, right? It's not just a simple box-checking exercise.
And that really is the multi-trillion-dollar question for all of us, isn't it? As ESG becomes totally standard, what trade-offs are we, as investors and as a society, willing to make for a truly sustainable future? The debate isn't about if this stuff matters anymore. We're past that. Now the real, messy, complicated work begins. Thanks for watching.